Hi, is anyone on? Mic check, 1, 2. Okay, good morning, everyone. I'm going to call to order the hearing of the Banking Committee this morning, Thursday, February 27th, 2025. Welcome to everyone. We have a few folks joining us online today. I don't know if we want to quickly say hello. My co-chair, Senator Miller. Morning, Senator Miller.
Good morning, Mr. Chair. Good morning, everyone. Thank you for being here today, and I'm sorry that I'm not there in person to join you. Thank you, Mr. Chair.
Okay, good morning. And I see Senator Berthel as well. Would you like to say hello, Senator
Yes,
Berthel?
good morning to both my chairs and my ranking. I have commitments in district today. I also unfortunately have to be remote, but looking forward to having a good hearing. Thank you, Mr. Chair.
Good to see you. And Representative Del Nicky.
Good morning, Mr. Chair. So today we have an opportunity to hear from the people on bills that we have before us. And without any delay, I think it's time to jump in there.
Okay.
Get the testimony.
Let's go. Thank you. Okay. First on our list this morning is Representative Lenahan. Welcome, Representative Lenahan.
Good morning. It's fun to be on this side, which is very rare for me. To the co-chairs, Representative Doucette and Senator Miller, vice chairs, ranking members, for the record, I am Liz Linehan, state representative of the 103rd District, which encompasses Cheshire, Hampden, and Wallingford. This testimony is in support of Senate Bill 1338, an act concerning the deletion of minors' money sharing application accounts. Thank you for introducing this legislation and for allowing me to speak here today. As you may be aware, I sat on and co-chaired the Committee on Children for the last 8 years. During that time, a significant portion of the committee's work was focused on ending adult sexual misconduct, child sex abuse, and child sex trafficking. The bill before you today is an extension of that work. More than a bill about banking data and privacy, this bill is also a needed fail-safe for child sex trafficking. I was contacted by the parent of a 15-year-old child in crisis. The parent was contacted by the Department of Children and Family Services after their therapist reported to the DCF Care Line that the child was at extreme risk of child sex trafficking. The therapist believed the child was having an inappropriate conversation with an adult and resulted in one of the adults opening a Cash App account for them and potentially using it to either collect money for sex acts with others, to pay the child to groom them or entice them, or even to pay the child for performing sex acts on the adult who sponsored that child. The parent found the app on the phone and immediately contacted Cash App customer service. The customer service representative noted that an adult opened the account for the minor in accordance with Cash App terms, but without a warrant, they cannot share that information with the parent or do anything about the account. The following is an excerpt from the parent's actual conversation with that Cash App representative. Mom, if a minor with mental health issues who, let's say, has a pimp over the age of 18, under your rules of service, this pimp can sponsor a Cash App account simply because he is a legal adult, even though he is unrelated to the child, because he attested to being my child's guardian. The response, hesitantly, yes. Cash App did subsequently send a response to this parent that they will fully cooperate with any law enforcement investigation, but that requests from anyone else, including parents and legal guardians, will be denied. Cash App terms of service as written provide very little protection in this regard. It says that anyone over the age of 28, which I believe has since been changed since the original conversation of 18, they can sponsor up to 4 children, and that adults, quote, will be required to attest to the relationship with the sponsored person. But it does not specifically require any backup documentation, such as a notarized statement or identification for the child, such as a birth certificate. One cannot expect that someone abusing a child will honestly attest to anything in pursuit of such abuse. The case of this Connecticut teen and their parent is not a one-off. Included in my written testimony. May I continue?
Please.
Thank you. Included in my written testimony is a white paper by the Polaris Project and the National Human Trafficking Hotline, highlighting cases of Cash App and other peer-to-peer payment apps as an oft-used component of sex trafficking. The cases highlighted include in-person sex trafficking, sextortion through social media, and rape. The legislation before you will put power back in the hands of parents to protect their children. The bill mirrors language in our data privacy and social media laws, which allow a parent to close an account on behalf of the child if it was opened without their knowledge, just like the law states for apps like Instagram, Snapchat, and others. But because Cash App, Zelle, and Venmo are considered money-sharing applications, they actually don't technically fall under the state's definition of social media. This legislation is needed to hold money-sharing apps to the same account, which we hold social media. Lines 37 through 41 of the bill as currently written may be the most important, which says all data shall include but not be limited to an itemization of each transaction associated with the account and the identity of the person who opened such account. This part of the bill will define that information as data belonging to the account holder or the minor and their parent, making it legally theirs to which they have access, and will ensure that a parent of any child who is being abused, groomed, or trafficked can protect their child from predators. A final note. I do ask that substitute language be offered which makes the entire bill effective for all children under the age of 18 instead of under 16 and 15, which is inconsistently applied throughout the bill. Additionally, the committee may wish to consider adding the additional step of requiring a notarized attestation for any sponsored accounts, which may be seen as a roadblock to the abuser and serve as a deterrent. Notaries are available for no charge at financial institutions, so requiring such information will not constitute a hardship for low-income families and need not apply to adult account holders. Thank you again for allowing me to testify. Thank you for raising this piece of legislation, and I wholeheartedly look forward to working with the committee to see its passage. Thank you.
Thank you, Representative, and thank you for your work on all of these issues over the years, your advocacy on behalf of children and families. If not for you bringing this forward, this is something that flies well below our radar. So it's wonderful to have you here bringing this forward. So a couple of questions. So basically, in a nutshell, this would provide for a parent to be able to close the account. And then there are some other actions that would be associated with that. Is that two questions? One is that sort of the model that you used for the social media legislation? And then two, does that track moving over to the, money sharing app space? Does that track with what other states have done?
Right now, we are not aware of any states that have actually done the same for cash apps as they have for social media, but it does work with what other states have done regarding social media and regarding the laws that we have on the books regarding closing an account of social media. What it really does is kind of marries our laws under this one umbrella of the cash sharing apps, because yes, it allows a parent to close it, but additionally, it also states that the data contained within that app now belongs to the minor and the parent. That data can be used to see what is happening to their child, specifically in terms of being trafficked, coerced, groomed, or abused.
Okay. And then the intersection of this and sort of law enforcement issues, have you heard, or do you have any experience with that in the at least the social media context? Are there any other ancillary issues we need to consider? Anything that, would touch on due process or criminal procedure?
Absolutely. And thank you so much for that question, because there are some questions that may still remain regarding that information. What I want to point out is that if we secure that the data contained within the app belongs to the person, the sponsored person, the minor child, or their parent, or I should say, and their parent, essentially what we're doing is we are no longer requiring that a warrant be needed to get the information. But I want to be very clear. that we do not need in this legislation to contact police in order to get it, which also does not run afoul of any laws regarding due process, because this is not happening in the context of an investigation, a police investigation. This is really for the purposes of the parent and for the safety of the child. If it then moves forward as a police investigation, the police then have access to more information and could secure a warrant, at which time the Cash App or any peer-to-peer information sharing service or banking service would have to comply with the warrant. So it's kind of that first step.
Okay. And then one last question, more of a mechanical one. What happens with the funds in the account? How should that be handled? Should they, would they basically be then, you know, if a parent is intervening, then the funds, once the account is closed, would be transferred back to the minor?
That is a
How
great
would we handle
question.
that?
So in front of me, I have 65 pages of the Cash App terms of service. And that money, I think that it kind of goes through a couple of different pieces where if it was considered to be in the commission of a crime where the child received that money, then they would have to follow applicable laws as to what happens there. But if this is just in the fact that there's money still in the account, the current terms of service, I think that there are, they denote who it belongs to. At this time, I am unsure if those would need to change, but I believe that by writing this legislation, what we do is then put the onus on the application to determine where those funds go based on their terms of service on any time that they would close that application,
Yeah.
that
Okay.
account rather.
Okay, good. Thank you again for your work on this.
Thank you so much, Mr. Chairman.
Questions? Other questions? Actually, I see a few online. I see my co-chair, Senator Miller.
Thank you. I'll yield to the ranking chair for now. Ranking member. And then I'll ask my question.
Okay. Senator Berthel.
Thank you, Mr. Chair. Thank you, Madam Chair, as well. Representative, thank you for bringing this matter before us. I will not repeat what the good chair, House Chair, has already said. I think his comments are spot on. The only thing that I think you probably have seen or maybe have not had time to see is that there is some concern with aligning the provisions of this bill with some existing state and federal law with respect to the closure of bank accounts and the definition of online apps and online accounts. So I think I heard you say in your closing remarks that you look forward to working with the committee on this bill. I think we will probably have to tweak this just a little bit in order to get it to over the finish line and in order to be in compliance with the state and federal laws. But as the good chair mentioned, this is something that we probably would never have thought about or realized was even a problem. So thank you again as well for bringing this to our attention. Thank you, Mr. Chair.
May I respond?
Sure.
I want to thank you very much for being open to that. I am absolutely willing to do what is needed. I think that this is an all hands on deck situation, but I did want to note that within my written testimony, which, and I can also send it via email to members of the committee, there is a white paper included that would explain more of how these instances happen. So as we work on language moving forward, I'm confident that understanding more of how this happens will help us create laws that can best save our children. So I thank you, sir, and I thank everyone on the committee for their attention to this.
Thank you.
Representative Delnicki.
Thank you, Mr. Chair, and thank you for bringing this issue forward. You stated that no other state has actually broached this issue and actually has passed something to remediate the issue.
To the best of my knowledge, and to be very clear that when we started working on this, it was at the end of last session. If something has passed since then, I have not received notification of that. But there are numerous states that have worked towards the social media applications, thinking really that social media is where the harm happens most often for these children. But as you can see by that case study and by the story of the young person here in Connecticut, it's actually much wider than that.
So the states that have addressed the social media portion of it, are they currently looking at the funds management portion that we're talking about here?
See, social media doesn't have that. They do have things like there's, Facebook Pay or something, but that's connected to a bank account. So something I also want to be clear, the difference between the social media payments is where you kind of connect your bank account and then it goes from your bank account to someone else and uses the social media as a conduit. These Cash App accounts, you have the option to use your bank account as a conduit and use them as a conduit, or you can still hold cash within those Cash Apps. So we have to be very careful about what we do there. I agree with everyone. And it may require a little bit more thought in how we have the final language, but I am willing to work with everybody to get to that point where everyone feels comfortable.
Yeah, point well taken there. I only raise those issues from the standpoint that if somebody else, some other states actually begun working on it, perhaps we could actually get the information, see what they're doing, and see if it actually addresses the issue that you brought forward.
Yeah, Representative, I would say that Connecticut has really been on the forefront of a lot of these issues. In fact, I believe that we had heard the bill on social media and closing down the account prior to California. It did take us longer to pass it as a part-time legislature, but California's law was really close to what we were considering doing for a couple of years prior. However, there are some issues with the fact that what we do in state needs to be across all other areas, right?
Mhm.
So I believe that we should not be concerned with being the first state to do that. I think that becoming the first state should be a badge of honor for us, and that Cash App being that they're around the country and around the world, that by changing their terms of service, we will not only be helping Connecticut children, but we'll be helping children across the country and across the world.
Well, I appreciate you coming forward with it. It's something that, quite honestly, I think we all never really thought about. And we want to get this right, obviously. Thank you.
Thank you, sir.
Senator Miller.
Thank you, Mr. Chair, and good morning, Representative Lenahan. I just had a couple questions. I was wondering if you could walk me through the process. First of all, how would Cash App know if I'm the parent or not?
Right now, the terms of service, all they do is require them to attest to the fact that they are opening this account for a minor for whom they have custody. Think of it like this. If you've opened a social media account lately, or if you have gone to a website about smoking or alcohol, you just have to click a box that says you're over the age of 21. That's essentially the same thing. Social media requires you to click a box to attest to the fact that you are of legal age, and pornographic websites require the same thing. It's that same process. So there's really, in the terms of service, it does say that if there is any question, we may require that you provide further documentation, including picture identification, but that did not happen in the case of this minor in Connecticut, and that did not happen in the case of the cases that we've provided for you through Polaris. And so we believe, and we being sex trafficking advocates and those who work on this legislation often, that in fact it being in the terms of service is just something to protect the application and the parent company, and not actually the child.
Okay. So if in this case, the example that you gave us and the mom says, hey, look, I want to close the account. I didn't open this account. Under your bill, under your proposal, do I have to prove that I am the parent? And if so, what do I have to present?
So under this bill, it does not actually speak to proving that. However, I'm open to language to do so. I do believe it's important. But right now, if you just need to attest to opening the account, the thought is you can attest to being a parent to close the account. If we ask in these applications to then strengthen their terms of service, I'm more than happy to require that the terms of service include a notarized attestation or documented proof of birth certificate that they are indeed the legal guardian.
Right. I mean, it's really up to you. These are just questions that I'm throwing out, right?
To
That
us.
I'm asking. And so, because I see it happening the other way, that I am the parent, I did open the account, and the pimp comes along and say, hey, look, no, I'm the parent, okay, and wanted to close the account. So would that happen? I don't know. And so that's why I'm just asking, do you have to prove that you are in fact the parent?
I
And
think
you
that's
did not.
genius. I didn't think of that, Senator. So the fact that you did actually just shows that this process is really important when we all come together and do what's best.
And you said that this bill is a fail-safe for child sex trafficking. Tell me how that will work. I'm a pimp, and so as a pimp, what would I do?
So if this bill, including the suggestions that I made, goes into law, and the suggestion actually that you made here today does get into law, essentially it would provide some sort of like speed bumps in the way of a pimp. I know I don't like that word, but we have to use it for what it's understood to be, that would have an abuser open an account. Those roadblocks would be that in order to open one of these sponsored accounts, that they need to actually provide documentation from a notary and possibly a birth certificate or something similar to prove that they are the parent and that they approve of this account.
Okay, I guess I should say, I'm sorry. I should have said, what I'm trying to get at is how did this happen? So let's take this parent, this
Oh.
young lady, like, how did this happen that, because you're saying that it's a fail-safe against sex trafficking. How would they use it to their advantage? That's what I'm asking. I'm
Oh, okay.
sorry.
So, no, understood. My apologies for that. So essentially, what happened in this case was that an adult who is of no relation took advantage of a child who was in the midst of a mental health crisis, and coerced them to open this account. In order to open the account under the terms of service, the adult simply had to open it and attest to being a parent and then transfer it to the child. Because Cash App, under their terms of service, they weren't able to provide us with the data to show. We don't know exactly who it was or what they went through. In fact, this 15-year-old child, is still considered in crisis. There is still a mental health crisis happening, and they are still working with DCF to ensure that they are safe. However, what we do know is that this child has admitted to having the idea of opening this Cash App account brought to the child. And it was absolutely used for the purposes, at the very least, of grooming. For
Okay. And you said that you wanted to make the bill stronger, so you talked about substitute language. You want to talk about that a little more? Give you an opportunity to dig into that a little more.
Thank you, Senator. I appreciate that so much. So yes, for the substitute language, if you look at the way the bill is written, there are some sections that talk about being under 16, some sections that talk about being under 15. The problem is that if you think about it, like a 17-year-old is still very much at risk for sex trafficking in these circumstances. And so the idea is that the substitute language should actually apply to everyone under the age of 18. It does not prohibit someone under the age of 18 from opening an account. It simply just allows this kind of fail-safe to be in effect. Additionally, I had mentioned before that there should be some identification needed to open the account to prove that they are the parent. And like you had mentioned, Senator, additionally, information to prove that you are the parent if you wish to close the account. I think that that's an important thing to add as well. And then as we move forward, if there are more questions that come about, I'm happy to sit with everyone and talk about additional substitute language.
Thank you. And so if I can make a comment, Mr. Chair, I want to thank you for the work, like my colleagues, the work that you've done around children and the safety of our children in this state. You know, it behooves me that if I wanted to open an account for my minor daughter at a bank, at a financial institution that has brick and mortar, I would have to prove that I'm the parent. I would have to give social security number, identification, and my child would not have access to those funds where they couldn't really withdraw the funds. And so I think that as a society, we need to start really thinking, putting some of those stops in these, I guess, electronic applications, and not just allow our children. Checking the box is not good enough, because as you stated, Representative, you know, individuals can be groomed, and our not children can be groomed. And I think as a society, we need to protect children more. And so I thank you for this, and I would really like to make it stronger, that there should be some identification just to even open the account for a child, just like you would do if I had to walk into a credit union or walk into a bank. They're not just going to let me walk in and say, oh yeah, open it up for Liz Linehan. So they're going to need identification that Liz Linehan and I are connected, and that I am the parent. And they call those custodial accounts. And I think that's what we need to have, custodial apps. So again, thank you for bringing this to our attention. And a lot of the legislation that we do in this building is based on experiences that our constituents have. And so again, I thank you, because your constituent isn't the only one with this problem. And we know that it will probably arise again. So again, thank you so much for bringing this to our committee.
Thank you very much, Senator. And if I just may very quickly, while I didn't include it in my testimony, you made a very good point about custodial accounts in financial institutions, but we also know that many times immigrant families and families of color are hesitant to use banking institutions. So they are more apt to start using these Cash App similar applications, which actually puts minority children at even greater risk of trafficking and grooming through the Cash App applications. So you are absolutely correct, Senator, and I'm very, very heartened by your thought on the ways that we need to strengthen this. So thank you so much.
Thank you, Madam.
Welcome to the Banking Committee and the world of fintechs. I mean, these are and once you sort of open up the box, you know, and unpack all of this, you know, all of these issues are ones that that we deal with, and the underbanked, and, you know, technology evolving, trying to keep up with it. So
Thank you.
it's all good stuff. So any other questions? Seeing none, thank you.
Thank you very
again.
much, sir.
Okay, next on our list, we have Jim Paris, and after him is Bob Wiedemann, and I think they're going to come up together. Gentlemen, thank you. We have like a mini panel here for us. Appreciate you joining us.
Good morning, Chairpersons Doucette and Miller, Ranking Members Delnicki and Berthel, and distinguished members of the Banks Committee. For the record, my name is Jim Paris, and I'm the CEO of the Home Builders and Remodelers Association of Connecticut. We represent over 900 businesses engaged in the residential construction industry in the state of Connecticut. And I'm joined today by Bob Wiedemann, our longtime Government Affairs Chairman and owner of Sunwood Development Corporation out of Wallingford. We're here today to testify in strong support of House Bill 6992, establishing the Homes for Connecticut Loan Program. As many of you know, Connecticut faces a severe housing shortage and affordability crisis, with home prices rising nearly 50% since 2020, while wages have been lagging behind. The state has one of the lowest housing production rates in the country. In 2023, Connecticut ranked 49th in housing permits per capita, failing to meet demand for workforce and middle-income housing. A lack of available starter homes has pushed homeownership out of reach for young families, first-time buyers, and middle-class workers, exacerbating the wealth inequity that we experience here in Connecticut. Homes for Connecticut Loan Program is a proactive solution to increase home construction, ensuring working families have a pathway to homeownership. The program leverages private sector lending by guaranteeing loans for home builders and developers to construct residential buildings. It encourages lenders to provide high loan-to-value ratio loans, addressing one of the biggest barriers to financing new homes. Subordinate loans will be available to builders, allowing them to secure funding for much-needed housing projects. The state backs the program with a $10 million loan guarantee fund, making it easier to finance home construction without burdening taxpayers long-term. By removing financial barriers for home builders, this program will accelerate the production of new homes, especially in areas that currently lack workforce housing. This program specifically targets for-sale housing, ensuring that Connecticut families, not out-of-state investors, benefit from new housing developments. Builders and developers will have access to financing at more favorable terms that traditional lending institutions would otherwise be hesitant to provide, helping small and mid-sized construction firms participate in the solution. Homeownership is the foundation of the American dream. This program ensures more Connecticut residents can afford to buy a home. Expanding homeownership opportunities builds generational wealth, particularly for lower and middle-income families who have been locked out of the market. Increasing housing supply reduces upward pressure on rents, helping not just home buyers, but also renters struggling with Connecticut's high cost of living. Construction of new homes will create jobs across the state, benefiting not just builders, but also suppliers, contractors, and the local economy. It's no secret that Connecticut has a housing shortage. Connecticut needs at least 137,000 additional housing units to meet demand according to the Partnership for Strong Communities. Median home prices in Connecticut have increased over 40% in just 4 years, and 80% of renters in the state say they can't afford to buy a home under current market conditions. And housing affordability is the top reason young professionals are leaving the state, reducing our workforce and hurting our economy. Connecticut cannot afford to wait. The housing shortage will only worsen without decisive action. And Homes for Connecticut Loan Program is a fiscally responsible, market-driven solution that removes barriers for builders while ensuring homes remain attainable for Connecticut families. Supporting this legislation means supporting Connecticut's working family, local economies, and the future of the state. This bill is a common sense step forward solving Connecticut's housing crisis, and I thank you for the opportunity to provide testimony in support of House Bill 6992. Thank you.
Thank you, Mr. Chairman. I'm not going to elaborate on what Jim just spoke about. The committee knows, where we are. I really just wanted to be here in case there are questions about how it works in the real world from a developer standpoint, builder standpoint. So I'm just really more here for questions if there are any.
Well, I certainly do have some, and I appreciate you being here for that. I guess to kind of frame the issue a little bit, we've talked pretty extensively, and we had a forum here. I know you were at a couple of weeks ago with the chief economist for the realtors and also the home builders, national home builders. Talking about how, first of all, this is a national problem, but particularly Connecticut has really lagged for new construction, really for about 20 years now, right? Talk a little bit about that, about some of the challenges, why you think we lag. I know there's sort of, economist reasons, but also, in terms of actually, putting the boots on the ground, why is it such a challenge here in Connecticut for new housing starts?
As you're certainly aware, Mr. Chairman, there are multiple reasons. There's planning and zoning issues. There's land use regulations. There's burdensome regulations at all levels. Obviously, the banking side of things is just one aspect of that, but there's not a single solution that's going to solve all the problems. But if we can address this one, as far as financing, especially for the starter home market, the lower price points are really difficult for a builder developer to go in, purchase a piece of land, get adequate financing to make all the numbers pencil out. So this is just one tool we're going to have in our toolbox that we don't currently have that's going to allow us to try to reach that lower price point, which is very, very difficult, again, for a number of reasons. I don't want to spend 2 hours discussing all of them, but from a banking standpoint, this is really a great tool that will really help us. And tying it in with the Chaffa financing, I think the bankers are on board, and I believe they're going to be speaking a little bit later about this, so they can give you their perspective on it. But I think it's going to be really helpful to encourage us to try to go for that, lower price point starter home market that we really have difficulty achieving now.
Yep, and that was going to be that segues into my next question nicely, because I do recognize that this is a harder sort of product when we talk about starter homes to build. And I recognize that there's not a ton of this out there right now, which again is the impetus for trying to increase the supply. So yeah, could you talk a little bit about some of the challenges, particularly in building in that starter home market, price point, and some of the challenges that we face? I recognize that it is sort of going to be a challenge for you guys to adapt to come up with a project that fits nicely into these parameters. I don't think it's impossible, which is why I think it's important to continue pushing this forward. But talk about some of the challenges, particularly for the starter home market, that low to moderate income market, and what these projects would look like. Because I've been describing them to people, I think, and we use the term pencil out when you look at it on your end, and you're the expert, not me, that it would be possible to build something in this market, maybe in sort of a condo townhome type of development. But talk about, sort of the challenges that you're hearing from, your fellow home builders as well about building, that sort of product in that market.
Yep, that's the perfect way to explain this is it's going to come down to density. And I think you're right. This is not going to fit every type of product or project out there. But I think when we can find property and locations, and as you know, the majority of the state is zoned for single family residential development on larger lots, acre plus, which this is probably not going to address. It's not going to address that zoning issue. But from a price standpoint, we have to get density in order to build more efficiently. And that's going to be your condominium developments, as you said, planned unit developments. I see this as being either attached product like townhomes, or maybe detached small units, planned unit developments, PUDs, that might be very fitting for seniors. What we're finding is that we're having the two segments of the market that we really can't address is starter homes and senior housing. People that are living in a large home that need to downsize, they can't afford their house, or maybe because of health issues or other reasons, they can't stay in their existing home, but there's not an opportunity to get out of that house. And quite honestly, that doesn't free the house up for another young family moving up. So I think it's going to address both of those parts, but it's going to come down to finding projects that have the density allowance in them that's going to make sense to utilize this program, build at that higher efficiency and lower price point.
And I understand it is hard, and we can't solve all the problems of the world here in the banking committee, as I said earlier this morning, as much as we would like to. A lot of other discussions, as you very well know, going on in this building about zoning and density. I leave those to others upstairs in those committees. But again, I do think it's possible to achieve the goals of what we're talking about here. It's not going to work everywhere with every home builder, with every project. But I do think it's possible to execute on this and add to the supply. Other questions for our home builder friends? Representative Delnicki.
Thank you, Mr. Chair, and thank you for coming forward here today. You touched upon interest rates for construction. What are you currently paying for money to have new construction loans, things of that nature. Can you tell us that, where you're at?
Yeah, so it comes down to two things. One is the banks look at it from what the risk level is. So it depends on loan to values, obviously a big issue. Lower loan to values, lower interest rates because the risk is lower. Higher interest rates for more risky developments. Typically, we're seeing loan to values of 60, 70% as typical, and base interest rates at 8 to 10%, something in that range. But then there are fees, points, and so forth on top of that. So out the door rates are probably more like 12 or maybe even a little bit higher than that when you get done with all your fees and so forth. So I think having this backstop will allow banks to better utilize their money with lower risk. But we have to balance that with the need that we don't want to just completely offset that risk and put it on the state of Connecticut either. So we do need, I think, in my personal opinion, is that we need everyone to have skin in the game. And that's what I really think. I don't think we want 100% financing. We don't want banks taking back projects that weren't really feasible without this program, or even with this program, maybe not feasible. So I think we do need to be sensitive to that balance. But if we can get those rates, down by a third, that would be outstanding and really help make the numbers kind of work all the way around.
Yeah, it's interesting. I took a quick look at Federal Home Loan Bank Boston, and those rates are significantly lower. But of course, it's a Federal Home Loan Bank. And if we can actually make this happen and we can have those rates, what would that mean to you folks when it comes to actually building a home?
So I think it'll give us an opportunity to look at projects that we otherwise would not even consider. I think that's really what we're trying to do is the stuff that we can do without you is going to happen anyway. So what you're going to do is allow us to do projects and product types that we ordinarily couldn't do. And the banks would not be interested in financing just because the economics just don't make sense. And I think that's really got to be the goal of this whole legislation, is to get additional units built.
I think if I could just add too, I think the reality is that, as Bob alluded to before, there's going to be a lot of skin in the game from everybody, lenders, builders, in the state. The assumption is that, builders will be building these products with probably a tighter profit margin. So that's why the lending has to be there. And we need to find the communities that will afford the proper density needed to make these projects happen.
Well, I appreciate you coming forward and your testimony, and thank you, Mr. Chair.
Your representative, Senator Miller online.
Thank you, Mr. Chair. Good morning, gentlemen. Thank you for being here today. Did you submit your testimonies?
I submitted my testimony late last night when I was
Okay.
from a conference, but I think Bob is going to be submitting his later today.
Okay. Yeah, if you would, I would love to read it. Question, my co-chair stated that it's not going to work everywhere. Can you give us an idea of where you think it will work, this program?
I don't think there's a region of the state where it won't work. I think it's going to be more about the individual towns and where we can get the density to make the economics work. And that's really the big problem we have right now, is that there are too many locations that think single family homes are the only kind of development they want, the type of housing they want. And that fits for many people, but it doesn't fit for everyone. And a lot of renters that would like to have ownership opportunities and build equity and that sort of thing need to look at higher density townhouses, condominiums, single family homes, but at a lower price point than it's currently available. So I think it's really going to come down to towns that are going to work in conjunction with builders, developers, and with programs like this, that they see the benefits, and we all come to the table together and create additional housing.
And I would just add too that this could be a really great tool for the municipal redevelopment agency to have in its toolbox when approaching towns and talking about the proper density needed for projects like this.
Yeah, thank you. I know that it is a problem in Stanford. I have constituents that are looking for starter homes, right? First-time home buyers, and there isn't anything out there. And it's a difficult market. And I know in Stanford, we are definitely so the rest of the state, we have a housing shortage. So I want to thank you gentlemen as well as my co-chair for bringing this bill forward. Thank you.
Thank you, Senator. Senator Berthel online.
Thank you, Mr. Chairman. Gentlemen, thank you for your testimony. I learned a little bit more about what's going on in Connecticut today based on some of the comments that you made. I have a question, though, and I don't know if it's an easy answer or if the answer is too complicated or whatnot. But if what you just explained to be the high rates that you're paying for construction for building projects, I think you said somewhere when you look at everything, you're at 10 or 12% plus various fees and whatnot. Let me ask you a question before I continue. Is it safe for me to assume, in the committee to assume that if you were if you were doing construction in any other state, that those rates would be about the same from the lenders in those other states?
Yes, to the best of my knowledge, I obviously don't work in other states, but I would assume that they'd be similar rates elsewhere.
Okay. All right. Thank you. That's what I thought as well, because generally interest rates are controlled by what's going on with the Fed and everything else. So I guess the tough question to ask here is, if that's true and the cost of construction is generally the same across the country, why are there housing booms in other states? And by your own words a moment ago, we've been short on new construction for 20 years in Connecticut. And I know the answer, and I guess it's rhetorical, but my question is rhetorical. But I think that on the surface, I like this program because I think it will certainly inspire your peers to have some of a bit of a safety net in terms of the investments that you'll make. And I know that it will also stimulate our local economy by providing and creating jobs and then all of the domino effect of that. But I remain concerned, as I have for a lot of years here in Hartford, that sometimes we build solutions without looking at the systemic cause of why things are more expensive here in Connecticut than they are even in some of our neighboring states. It would be easy for me to make a comment about Florida. I happen to visit Florida a lot, and you go into any town, any city in Florida, and you get caught in traffic because of construction vehicles, and they're just building and building and building and building. And back to my original comment, if the cost of construction is the same, generally speaking, in Florida as it is in Connecticut, why is there a huge boom down there and the prices are out of control in terms of retail costs to buy a home compared to Connecticut? So if you want to respond to any of that, please do. It was more of just my questioning here and my comments here are more for understanding and just trying to really wrap my head around what we're trying to do with the bill. But thank you, Mr. Chairman. If they'd like to respond, please have them do so.
Sure. Thank you. I'll give the short answer now. I'll allow Bob to elaborate like I know he can. The reality is Connecticut is a high-cost state. And the National Association of Home Builders puts out a study regularly and just recently posted its findings, basically saying that there's a direct correlation between the high level of regulations and the low level of housing production. So I'll leave it at that and let Bob elaborate if he likes.
Yeah, I would basically agree. I think it's twofold. It's the regulations for sure, and we're not going to solve that here. And I don't know if we'll ever solve it in Connecticut, quite honestly. It'd be nice to make some adjustments. But there's so many steps that we go from a raw piece of land or a redevelopment of a site to finally get to an end product. One thing I just want to mention is that, and I think we're addressing this in this bill, is that we're trying to keep the bill as simple as possible. If we don't want to discourage for-profit builders to get involved. And we're talking about typically small builders that don't deal well with bureaucracy. And so by putting the onus on the banks to sort of manage the process takes out a layer. If you told me I need to go to the state and have a whole nother set of applications and responsibilities and fees and everything else, I'm just going to throw my hands up and go, I'm just going to go do something else. So, and I think we've tried to address it in this bill as it is now. And I hope we can continue to focus on that we need to have it designed in such a way that it's very easy to use. you guys don't want to have to create a whole nother bureaucracy to manage the loan or the guarantee of the loan, but leave that to the responsibility of the bank that's backing the primary financing of it. And I think that's being addressed, but I just want to put that out there that I think it's really important that we need to keep the process as simple as possible.
Mr. Chair, if I may just quickly respond to that. Thank you. I couldn't agree more. And again, I appreciate your support of the bill. I do think it stands very strongly on its merits. There's a few things I think we need to figure out, but thank you for your answers. Mr. Chairman, thank you for recognizing me.
Thank you, Senator. Rep. Hoxa.
Thank you, Mr. Chairman. Just one quick question, if I may. Do you folks believe that there is, you had said previously that Connecticut is lagging in terms of new construction. Do you believe that there's also that part of the reason that that's the case is because of any local ordinances or local building departments, the way we do business at a local level here in Connecticut, or do you think this is mainly a state level issue? Through you, Mr. Chair.
It's kind of a hot potato, but yes, 169 towns with their own sets of rules and regulations definitely complicates the process. And there are some towns very supportive of housing in general and lower cost housing, and there are other towns that would prefer that there's never another home built in their town that's not worth more than $1 million. I'm sorry to say it, but that's the honest truth.
Now, through you, Mr. Chair, if I could have one more question. When the building codes in each town, I believe they're referred to as the international building codes. So I'm not a legal expert, but I think the word international is pretty self-explanatory. When you say that there's 169 towns with 169 different ways of doing business, I guess I'm paraphrasing, not quoting you directly, it wouldn't have anything to do with the building codes per se. You're talking about other things, correct?
That is correct. I will say that in Connecticut, the building code is actually the one process that is universal across the state. That there's not a different set of rules in each town, which is probably the strongest regulatory system we have. We don't have that in zoning. We don't have it in wetlands, even though we have state statutes that sort of direct and dictate. It's still left to the local town and municipalities to decide how they're enforced and how strictly they're enforced. The building code is the example we should all be striving for, because that is a single code throughout the state. There is a process. I think personally, I think the code has maybe gotten a little beyond what it was originally intended, which was to create protections for health and safety only. And we've gotten into energy efficiency areas that maybe are beyond what we should be worrying about, and other areas that are probably making the cost more expensive. But at least we know when we walk into a town what the rules are going to be from a building code standpoint. So the building departments are not necessarily the issue.
And I would just add to that, I'm not saying whether or not the codes in the state of Connecticut are good or bad. We are currently in the process of adopting the 2024 code. Will be one of the first states in the country to do so. We actually were the first state in the country to adopt the 2021 code. The reality is there are states without codes. There are states on the 2009 code. There are states on various codes in between. And the reality is every time the codes are adopted, there is additional costs associated with those codes.
Thank you, Mr. Chair.
Thank you. No, it's like I said, it was very interesting to listen to the chief economist for the home builders talk about the scene nationally and throughout that statistic about regulation, generally speaking, across the country. And I think I saw clearly through that, thinking about Connecticut specifically, and what that means here is local regulation, local zoning regulation. So I think we do have to do something there. We do have to do something there. It's unacceptable, really, that, again, we have towns that, like you said, Bob, don't want anything to be built within their town. And I think we do have to push on that. I know some of my colleagues elsewhere in the building would probably not like it if we introduced legislation here in the banking committee to deal with that. So that's why I'm tackling this piece of it and hopeful that this will have an impact. Any other questions? Seeing none. Thank you, gentlemen. Thank you for
very much,
joining
Andrew.
us today.
Thank you for your time.
Okay, next on our list is Diana Good from the Connecticut Council on Problem Gambling.
Hi.
Morning.
So I'm Diana Good from the Connecticut Council on Problem Gambling, and I brought Paul Tarbox with me today, who I know some of you already know. We are here to support SB number 1337. So I just want to start by saying that Connecticut Council isn't for or against gambling. We just want to make sure that there are safeguards in place, especially as gambling becomes easier and more accessible. We want to make sure that there are safeguards in place to protect people from gambling related harms. We also want to promote programs that help people in recovery. And we think that this bill goes a long way to support people in recovery. We do have a couple changes or suggestions that we think might make this bill a little bit stronger. So the bill currently applies only to unsecured debt incurred on or after January 1st, 2026. We are hoping that that date can be pushed earlier to maybe January 1st, 2025, or even earlier than that. The reality is that most individuals struggling with gambling related debt have accumulated substantial balances over many years, often with significant interest and fees. Excuse me. In many cases, older debts are more burdensome as they have grown due to compounding interest and penalties. We think the bill would be a lot stronger if that date was just pushed a little bit back. The bill also excludes secured debt, such as home equity lines of credit and auto loans. Those impacted by gambling-related problems often take out high-interest loans against homes and vehicles, only to find themselves trapped in overwhelming debt. If the intent of the bill is to protect those actively seeking help, limiting the scope to only unsecured debt may leave people at risk and without relief. The bill also takes a broad approach by allowing individuals in a gambling treatment program to qualify for relief. Further clarification is needed regarding what constitutes an eligible program to ensure proper application and prevent misuse. We would recommend using the Better Choice programs, which are gambling-specific treatment programs funded by the state of Connecticut. The bill doesn't specify how an individual proves their participation in a gambling treatment program. We would recommend a verification process where a licensed clinician certified in gambling treatment disorders certify and enroll and continue to monitor that participation in the program. Bill 1337 is a critical step towards recognizing gambling disorder as a serious financial and public health issue. This bill would allow those in the early stages of recovery to have a brief pause from the constant phone calls, emails, and physical letters demanding repayment. It is our hope that this respite would allow them the ability to focus on their journey towards recovery. Treatment combined with financial counseling to individuals and families that are experiencing gambling-related financial distress can allow a real chance for someone to begin to repair the damage that gambling-related harm has caused. So thank you for listening. Those were our suggestions about how we can make this bill stronger. I didn't get buzzed. Sorry.
Well done. Well done. Thank you. You touched on one issue that was going to be a question of mine for you, and that is the definition of a problem gambling program. If we were to move forward on this, again, we would want some specificity, I think, as to what qualifies. So if we were to do that, what would you suggest? What qualifies? And you probably know a lot of these programs, we would want to, I guess, tailor our definition to those programs. So
Absolutely.
what are your
I
thoughts
always
on
say
that?
if you're going to be a problem gambler, you want to be a problem gambler in Connecticut because we have great treatment programs that cover the entire state. So those Better Choice programs, in most cases, are free to people if insurance doesn't cover it. There's a chronic gamblers fund that's funded through the state lottery so that people can get treatment in Connecticut for free. The other great thing about the Better Choice programs is that also family members can get treatment as well. Because one of the things that we know about gambling is it doesn't just affect the gambler in a lot of cases, it affects the whole family. So even if the gambler isn't ready for treatment, we can get the family into treatment at the Better Choice programs. So I can't say enough about how great these Better Choice programs are. You know, we run the helpline at the Connecticut Council. So we're getting the calls from people who are really in distress. And for us to be able to pass them on to a Better Choice programs is a huge relief for us because we know they're going to meet these counselors. And if they stick with the program, the odds are they're going to be okay. So I can't say enough good things about the Better Choice programs.
And do you think we could come up with a list of those programs
Sure,
that
we
we
have
could?
a list. We
Okay.
can send that to you. There are 5 of them across the state. So we could,
Okay, so there are 5 of them.
Yeah.
That's good.
yeah.
And then in terms of, um, qualifying those programs or who would, and this kind of leads to my next question. I don't know if you saw the testimony that was submitted by the judicial branch. They had a lot of questions about the mechanics of this. And again, who, one would sort of qualify as a problem gambling program, and then 2, who would, provide the notice. What would that notice actually look like to sort of certify, for lack of a better term, that program is legitimate, that person is enrolled in the program, and how, a court or a creditor or a court ultimately would get notice of that program. I mean, would your office or would those programs be able to participate to such a level that they'd be able to sort of provide that certification, do you think?
Yeah, we think that the certified clinicians at these programs can make sure that people are in the program and can certify that they are continuing with the program. So we think the counselors at the Better Choice programs are equipped to do that.
Other questions? I see Senator Miller.
Thank you. Thank you for testifying on this bill today. I have a question. Can you walk us through the process? I am a gambler. I'm seeking recovery and I have debt. How would this bill help me or apply to me?
So this bill would give you 30 days to not have creditors calling you, emailing you, and writing you letters. It really is just a 30-day pause on creditors being able to go after you for repayment. And we think that 30-day pause will allow people to just take a deep breath and get their act together to be able to move forward with recovery and move forward with a plan to how to get out of debt.
And what happens at the end of the 30 days?
Well, as far as I'm concerned, I mean, if it's only a 30-day program, so then they would hopefully come up with a plan to repay these debts and start paying off these debts and work with their creditors.
So you're saying that the program itself, the respite program, is only 30 days? You can't stay in a program longer in recovery?
So you can stay longer in recovery, absolutely. This program is only 30 days a respite from creditors. So
Okay.
you can really change it so it's 90 days. You can make that longer than 30 days. But
That's the point I'm getting to. So why did you choose 30 days?
I don't know. Why did we choose 30 days? I'm sorry.
Hi, Senator. It
Hi.
was currently, the bill was drafted. We would definitely be open to the expiration of 90 days or further, especially if we're tying it with Connecticut specified clinicians that are already kind of certified in gaming disorder or gambling disorder, where they're seeing these clients, they're responsible for them, so they can know that it's not a misuse of the program.
We thought it was really a step forward. If we started with the 30 days and people were successful with this 30 days, coming up with a plan, some people may not need 30 days. If they can come up with a plan sooner than that, then they can start paying off their creditors before that. But we just saw 30 days as a first step.
Okay. The reason I ask is because most creditors don't come after you until the due date. So it may be 27 days, maybe 30 days. And so I was just trying to understand how would this give me a breather when they don't, technically they don't come after me anyway. I'm not technically late until after the due date, which could be the 30 days. And so that's why I had asked the question. So when does that 30 days start? When does the clock start?
I understand your question more now. So this is 30 days for when they start into the program, and this is people who are in significant debt. This isn't just someone who hasn't paid their credit card bill from last month. These are people who are in significant financial debt because of their gambling. So this is just a 30-day break from creditors coming after them. They're already coming after them because they're already in arrears.
I just wanted you to walk through the process for the public, because the public isn't really looking at reading the bills like we're reading the bills. And so just to walk through the process of how that would work if I was one of those individuals, right? So number one, I would have to have been in significant debt, have significant debt. I would have to already been in the collection process, correct? Is there anything else that would be required for me to qualify for this program?
No, significant debt being in the program would be the requirement. Did you have something?
It's probably also important to note that there's organizations across the state and some across the country that specialize in financial counseling for people that have incurred debts with gambling-related harm. We would obviously like to see the pause combined with the person entering in treatment, and also kind of having them, subsequently kind of hooked up with one of these counselors that can help them kind of get their financial houses in order with the proper budgeting plans and know the appropriate state and federal benefits to trying to mitigate whatever the debts incurred are at that moment.
Okay, thank you, Mr. Chair, and thank you for being here today.
Thank you.
Thank you. Any other questions? Representative Delnicki.
I'm not sure that you may have already answered this question. How are you going to validate that someone's actually attending these classes or programs? And would there be some kind of attendance that would be taken to prove that they're actually doing this?
So that would be done through the Better Choice programs. We're recommending that the certified gambling counselor that is giving the person treatment is the one that certifies that they are in the program.
And they would notify the debtor that the person is actually attending the classes?
Correct. And participating and staying in the classes. Correct.
Okay, thank you.
Not really classes, the treatment program.
Okay, the program, regardless of how you want to term it,
There.
is attending.
Correct.
Okay.
Thank you. Representative Hoxa.
Thank you, Mr. Chairman. Just a quick question. Would these, how far back are we talking about as far as debt incurred, and and also how soon can someone be eligible? Like, how old does the debt need to be for someone to be eligible for this program? And also, well, let's get the answer to that first, and then I'll see if I have a follow-up through you, Mr. Chair.
So that was one of the concerns about this bill. It's January 1st, 2026. So it would be current debt moving forward. So that's why we're trying to change that date back to at least January 1st, 2025, or even earlier. It doesn't include old debt, it's only including new debt.
I see. So anyone that essentially incurs debt at a very substantial level through means of a credit card, personal loan, however, and this needs to be like provable debt, right? Not like,
Correct.
private loans from family members and things like that. Anyone that incurs such debt and can prove that they incurred the debt to feed a gambling addiction would be eligible for this program. Not someone that has had incurred that incurred such debt over years, or sometimes maybe even decades for some people. Those people would not be eligible, is what you're saying.
As it's written now, correct.
Thank you. And one more question, Mr. Chair. So this 30-day period after a person enrolls themselves in this program, does that also apply to family members that maybe co-signed on loans and also provided their phone number? For example, like a spouse or a brother or sister that co-sponsored a loan from co-signed a loan from a bank for this individual in the program?
Does it include that?
I didn't see anything currently in the bill as drafted that touched on that, but it's a good point that's worth a consideration.
Yeah. So for example, if like husband and a wife, right, one of them is in this program, but their phone numbers are, especially nowadays, people don't have landlines. They provide cell phone numbers. Both their cell phone numbers are on, in the system. Whether credit card company or a brick and mortar bank. Essentially it would still, serve as continuing the issue that this bill is trying to alleviate, which is the harassing phone calls. If the creditor is still calling the residence via the cell phone of the spouse, it would still sort of, not accomplish that objective that the bill seeks to accomplish if the household is still, in a sense, getting these phone calls. So if this is a bill, that I will look to support, I'd like to see that added in there. I think it would just, make sense if what we're trying to do is create this sort of 30-day sanctuary period for the individual. I think, it should also apply to, to the spouse and to the household.
Makes a lot of sense. If the family member is in treatment, then it would apply to them. But I totally agree with you that it needs to be expanded to family member, the household. Yeah, it's a good point.
Representative, have you seen the testimony that was submitted online? I know a lot of it gets uploaded right before the hearing. We have the Connecticut Creditor Bar Association, who, it's kind of a frequent flyer here. We get testimony from them a lot. Everybody loves to hear from their local debt collector, but they actually have submitted a lot of constructive feedback on this bill and then others in the past. So, and the Bankers Association just asked that you review that and, be willing to work with them on a lot of the mechanics of this. But, I do commend you for bringing this forward, for all the good work you're doing across the state, and appreciate your testimony today.
Thank you.
Thank you. Okay, next on our list, I have Jacqueline Crenshaw. Good afternoon. Yeah, hit the button. There you go.
Good afternoon. My name is Jacqueline Crenshaw. I'm actually a private citizen of East Haven, Connecticut, but I'm also strongly supported by the AARP for my trauma that I recently had. But good afternoon, Senator Miller and Representative Doucette and members of the committee. Thank you for the opportunity to share my story with you and encourage your support for both House Bill 6690 as well as your consideration of changes to make it stronger. I am a victim of a long and complicated romance and cryptocurrency scam, and I feel very strongly about coming out of the shadows, about speaking about deregulation of e-wallets in Connecticut. This deregulation of e-wallets in Connecticut has had a devastating impact on my life, both financially and emotionally. The lack of oversight and regulation has made it increasingly easy for scammers to target individuals like me, resulting in significant losses. The first blow came when I, for the first time ever, joined an online dating service and became the victim of a romance and crypto scam. That scam, a financial crime, was a cryptocurrency investment scheme that promised high returns. At first, it seemed like a legitimate opportunity, especially with the ease of using my e-wallet for transactions. However, after transferring substantial amounts of money into the scheme, after some time, I realized that it was a scam. Many months later, the platform was having issues, then eventually disappeared. My funds were gone, and the e-wallet that had made my transaction so seamless also made it harder for me to track and recover my losses. But the financial damage didn't stop there. I was involved in this online romance that seemed real and comforting. He prayed with me every day. The person I was talking to seemed genuine and caring, and we quickly formed a bond. There were other forms of financial fraud at the same time. This person actually sent me a check for $100,000 for our future in investments. I initially went to my local police and called the bank that had issued the check. Both brushed me off and said, oh, wait, see if it clears. The check did clear. And after almost a year and many transactions of me investing my life savings, pension, and remortgage of my home, I realized the full extent of the scam. Even then, a call was made to the same local police department stating, and it was someone with a thick Indian accent, as I was told, said that they felt sorry for me because I was being scammed. This person that I trusted and had been manipulating my emotions to exploit me financially. The emotional toll of these experiences have been just as devastating as the financial losses. I now feel betrayed, embarrassed, and ashamed for trusting the cryptocurrency scheme and the person I thought I loved. The absence of regulatory measures to protect consumers from these scams in Connecticut has made me feel vulnerable and helpless. It also leaves law enforcement without the tools needed to help victims. What should have been a simple, secure way to manage my money has instead been a doorway to heartache, stress, and overwhelming financial loss. I am an educated professional woman left grappling with the consequences of a system that has failed to protect me. The deregulation of e-wallets has not only made financial scams easier for criminals around the world, but has also left me emotionally scarred. I wish that there had been stricter regulations in place to safeguard against these types of fraud, as it may have spared me and countless others from falling victim to these schemes. And working with professionals on my case and my self-advocacy, I understand that this bill would serve people in a position like mine better if it was strengthened to incorporate language found in, I'm almost done, House Bill 5237, which would define digital currency in a penal code and allow for the pre-conviction confiscation of digital wallets associated with thefts, and House Bill 6652, which would make it easier to prosecute cryptocurrency theft. Please do all you can to help law enforcement help people like me, victims like me. Thank you.
Thank you, Jacqueline. Thank you so much for your testimony. You said at the outset, and we see it here pretty frequently, because what we're doing is all in the realm of consumer protection, and there are stories behind it. And we base a lot of what we do in terms of legislation based on, here in the Banking Committee on financial fraud and consumer protection. But so often people are reluctant to come forward, because why do you want to relive that? So it's so important that you're here and appreciate
I've
it.
taken this on as it's going to be my job. Because first of all, I want to say, as an African-American woman, culturally, people are embarrassed. They would never want to come forward. And if you've seen on TV lately, and I've been on WABC everywhere, it's close to $1 million. So people would be mortified. They'd probably rather die. But I have fight in me. I have AARP behind me, and I'm going to do everything I can to try to help others so it doesn't happen to them.
No, thank you. And I did see you. I just placed it while you were testifying, I think in Connecticut
Yeah.
Post or in the Hearst.
I've worked 40
article.
years in radiology. I was set to retire, and I'm a pillar in my community with helping with mammography and breast imaging, and I've testified to the Capitol here for other bills. So to be here today, it takes a lot of courage, and I'm a victim. That's what I keep telling myself.
Well, again, thank you. Thank you for coming forward. I did have some questions about your case and how it all went down. And I'm most interested, with what we're talking about here with this bill. And it occurred to me too, we have others in terms of digital wallets and that sort of thing. We actually have another bill, I believe it's on today's agenda, that deals with sort of the kind of nitty gritty on the disclosures and requirements for digital wallets. But on this one, in terms of law enforcement getting involved, who did you initially contact? You said the local police, but who ultimately got involved? Was it also the state police?
Right.
And then how did it get resolved, or did it get resolved in any way? Were they able to track anything anywhere, or
No. Well,
get any money back for you?
No money back. But thank God there's only 2 state trooper detectives in this state, and that's Detective Mike Grabowski and Detective Matt Hogan, who are trying to work these cases. And, you know, parts of Connecticut are wealthy areas. And I think a lot of people have just not reported it. They could afford to not report a $50,000 loss, a $75,000 loss. So me, who that was my life savings, I'm losing my home, everything, I have to speak out. But I did initially, you know, my girlfriend and I were kind of, again, I don't have social media because I manage 50 women. I don't want to know what they're doing. I don't want to know what I'm doing. But my first time online on a dating service, which I find is full of scammers. And I also, if people ask me, they asked me, what would you do or what would you suggest? I suggest on an online dating, there should be a warning. If you get off that platform, beware, because that's what happened to me. Once you're off the platform and it's email, phone, the danger starts. So that would be one thing that I would suggest for any online dating service. But again, my girlfriend, you know, and they try to isolate you, but that didn't happen with me. My girlfriend, I get this check and she's like, you know, you got to go to the police. So yes, I go to the East Haven Police Department. I have the check and it's, you know, I deposit in my account. And, you know, I think even when I was there testifying, the person or persons wanted me to transfer the money to them. He recorded it and nothing. So we called the bank that issued the check, which was Truist Bank in Florida. And at the time, and I later found out from Detective Hogan, that an elderly woman in Florida was also being scammed and she didn't know it at the time. So maybe that would have helped me. She thought she was sending money to an investor who she thought I was. And that's how that $100,000 check got to me.
So that, in other words, that was her check. That was her money.
Check, yes, which I was trying to return, but the bank said fine. And at the time, she didn't know she was being scammed. So she was probably in a romantic and cryptocurrency scam as well. Because again, only by the detective later on finding out that she too was scammed.
And then that money went and got invested somewhere or
Yes,
in a
right.
cryptocurrency.
And again, I was coached and I bought and sold and traded Bitcoin. But when it went to this e-wallet, which was the Exodus wallet, it was gone. But I was sent fake receipts of my growing investment.
That was going to be another one of my question. Was that the name of the platform, the exchange, Exodus?
Exodus wallet, yeah, and they use an authenticator. So again, the money is legit. It gets there, poof, it's gone, and I'm getting receipts from like a coin cluster. And I even I did a little digging, but to no avail. And I want to say, since this was international, because I think Detective Hogan even said he traced one of the wallets to Nigeria. They're always a step ahead of you, no matter what. And they gain my trust. So yes, did I let my guard down?
Well, thank you again. There are other questions. Senator Miller is online.
Thank you, Mr. Chair, and thank you, Ms. Crenshaw, for your bravery to do what you're doing today and to go and be interviewed on the platform that you're being interviewed, which is nationwide. That takes courage. And I know, you know, being Black myself and growing up, you're taught that what goes on in the house stays in the house. And so I really do want to say that I am so sorry that that happened to you. And thank you for shedding light on this, because I had not. I've heard of the schemes, the romantic scams, right? But not to the extent that you were scammed, where he romanced you and sent you gifts. And so he set you up. So don't think that you were a fool. Don't criticize yourself, because I would have fallen into the same trap. Here was a man, he was doing everything for me. And so now he wants me to do something for him. I love him. So yes, I probably would have done the same thing. And I can say a lot of women would, because unlike some of the scams, I had a friend, he wooed her. I guess he did it for a month, got off the platform. He sent her hotel receipts that he was coming to the country. He said, I'm at an oil rig and I need some money because I'm sending you a diamond ring. We're going to buy a house, but I need the money so that it's in customs. And so I said to her, don't do it. And when I went and researched, and all the lines that he was giving her, it was a scam. He was getting them from a website. And so I know you've lost a lot. And you say that you're a victim, but you know what? Right now you're showing whomever done that and other women that you are a victor, that you are going to overcome this. And so again, thank you, because we are very strong advocates for consumer protection. That's what this committee is about as well, is protecting the people of this state. And so I just want to say, I'm so sorry that that happened to you. Thank you for your strength, because to do what you're doing right now, it takes an inner strength. You had to pull deep down inside to stand here before a group of people that you don't know and tell that story. And so I just want to say thank you and God bless you for doing what you're doing today.
Thank you. I just also want to add that this crime has seen a 40% increase since 2023. And my crime started in June of 2023. And there are still only 2 detectives working on all these cases. So they need help as well.
Thank you. Representative.
I'm sorry, if I may, Mr. Chair, I'm sorry.
Yes.
If I may, I'm sorry. And so thank you for saying that. I want to make the other point is that Detective Hogan has worked with this, and he and his partner have worked with this committee, and the work that we've done on cryptos and the scams and the abuse has come from him. And I agree with you. I think that as a state, we see that this is growing. This is an abuse that's growing and it's getting bigger. And so it's spreading, and that we need to also increase the department, that staff, because that's not really a department I'm understood, that I understand. So if you can spread that word wherever you go, that they do need help. And thank you for bringing that to light, because I agree with you. Thank you, Mr. Chair. I forgot that last question. Sorry.
It's quite all right. Thank you. Representative Foster.
Thank you for being here today. I'm sad this is the first time that we're meeting,
Yeah.
because you participated in an interview that was a follow-up in the series that I
Yes.
participated in. I've also had conversations with the same thought partner on this legislation. And I think what you're talking about is important. And I think it's really important to hear from your voice as we're navigating this process. Can I ask you what you wish you would have known sooner, or what you wish would have happened sooner in this process as you've navigated
Right.
through law enforcement?
I think I depended on my local police to maybe intervene, or not just, or them, they need to be, I know now that all the local police departments need more education on this. So I'm sure I'm not the first person that contacted them, but that's where I went first, because where else would I go? And it was only then that after there was really no action. And, I was traumatized by going to my mailbox and knowing that all these different things had happened and accounts taken out in my name, that, Detective Hogan and Grabowski met with me. It was dramatic. I had a suitcase of 10,000 emails, text messages that took the Geek Squad hours to get off of my phone. But I don't know, something just deep inside of me is like, I'm not taking this sitting down. And I know others aren't going to come forward, because just in the last 2 months since January, I've heard stories of my coworker's son losing 65,000 to crypto, all these stories that people just would not come forward.
Yeah. And I interestingly, my passion and the corresponding bill that I introduced that, I think it inspired part of this committee's work on this process, I had a constituent who had a life savings worth that he set aside, hoping he'd leave his kids with an inheritance. And he thought he was getting advice from a really renowned fiscal analyst on social media. It had his name and likeness as part of the advocacy. And what frustrated him to all get out is that after he identified this was a scam and it was reported to police, the scammer's account, the social media page, stayed active for a very long time. And so he continued to send our local PD and state information about how, like, he's continuing to scam people. It's going to keep on happening. They're going to keep on getting money. And eventually, we sent the information as a formal complaint to Meta through the legislature, and they don't really have a pathway to create protections in this space, which is a big problem for multiple, probably for the federal delegation to help us on. But we we have some tools, certainly not enough. One of the things that that my proposed bill on cryptocurrency asset forfeiture would do is would allow for sort of noticing of a account, freezing of it. The warrant has to be delivered in a non-traditional way. I don't know if to this date you know the name of the person who is scamming you, and
They
so
gave a
that makes
false
it
name, right?
that makes it challenging to deliver a warrant, freeze an account, and get the money back. So I'm hopeful that we can get to a place in this committee where this bill gets forward and would allow someone in your situation to get money recovered and back to you. And I'm so sorry for what you went through. Is there anything else that you think we should be thinking about throughout this process? You know, the committee is cognizant.
Right.
The bigger the bill gets, the more it
Right.
spreads. But I'm thinking this is going to be a multi-year effort where we're looking at
Right.
cryptocurrency
So
crimes.
almost a year later, because this started in June of 2023, and I didn't find out till June of 2024. But I think about May or June of 2024, I got an email from Bitcoin saying, "Oh, we think that your account now, a whole year later, has been traced to scammers," which of course it was too late.
So that's interesting about accountability for the companies that house them to monitor for activity and accounts that are known to be associated with crimes. So that perhaps is something under the cognizance of this committee. I don't want to freak out the chair by asking this question. It's certainly not under the cognizance of banking, but in the future, in next year, my hope is to bring to the finance committee the opportunity that if you have a documented loss in money, that you don't end up having to pay taxes to the state on the money. Yeah, I see your reaction. Okay, so do you want
I
to tell us
didn't
what happened?
gotten to that point
Yeah.
yet because again, I surrendered my 403B, you know, refinanced the mortgage. So all those things are still another hurdle that, you know, I'm going to have to deal with, along with losing my home. So I mean, I look at the glass half full. I have my health and I do have a good job, but I'm penniless. So it's hard to hire an attorney or an investigator or any things like that. But like I said, with AARP, they've been, you know, connecting me. I've talked to someone I interviewed in the UK. I did Shamrock, Operation Shamrock, and, you know, WABC. So I've taken on this as like a part-time job to be a crusader to hopefully help people that are like right at this moment, someone's being scammed. Lots of people.
Yeah. And I think too few people get their money back when this is happening. So I just want to sort of highlight that for the committee to think about, because this is not likely under the Department of Banking, but I think we'll need a collaborative effort from this team in advocacy to finance in future years, that sometimes people are paying penalties for withdrawing money from their 401k. And maybe this could be a warning that we require when people unexpectedly are pulling money out of those types of things. We can say, you know, we've seen an increase in people withdrawing money from their retirement savings accounts. If you are doing it under these conditions, that certainly would be the cognizance of the
Right.
Department of Banking is the warning. But what I wonder is the tax liability that then victims are, in addition to everything else that they're having to do, if that is a place where the state can say, you are involved in this, in this, you are a victim of this crime. The state is acknowledging it by helping you investigate this through the state
Right.
police or your local law enforcement. And so, like, we are not going to kick you in the gut while you're down.
Right.
And we are going to forgive your tax liability because it, but yeah.
Well,
So
on the
I
one,
just think
yeah, no,
fundamentally
and on
maybe
the
we could
one
do something.
hand, I'm sure I was Googled and all these things. Like I said, I'm a pillar in my community. If you see all the things I've done with mammography, but I was 59 and a half in January of 2024. I'm 60. So, you know, you're able to take that 403B and invest it wherever you want, but still, you know, just under false pretenses.
Yeah. I am so sorry for what's happened to you, but I'm incredibly, incredibly grateful to you for being here today because I think we need people to know how important this
It's
work
really,
is.
really prevalent. And like I said, people are hiding in the shadows, so embarrassed. I'm a victim.
Thank you for sharing. Thank you.
Thank you, Representative. Good suggestions, and you never freak me out. I've gotten used to it. I was just going to say that. You said it. Took the words right out. No, really, a lot of important considerations here with this. I would fully support, again, squarely within the Finance Committee, to do that. But, interestingly, where we're talking now, I know they're talking in Washington about extending these, the current, tax cuts that were implemented in 2017. And part of that's when the deduction for losses due to frauds of this nature or any nature went away.
Yeah.
So, we could certainly help here on the state level. It would be a bigger help if, federal taxes, where we send most of our tax money, would also be willing to do the same. But maybe it's something we could look at and work with the Finance Committee to get done this year.
Thank you.
But no, a lot of moving parts to this, and I'll tell you, we're committed to moving this forward. This bill is just a starting point. We need input from not only people like you, but also from law enforcement on how to most efficiently get after this. So we're gonna embark on that, and certainly have my word that we're gonna work on it in the very near term
Thank
here.
you. Can I just say thank you to Nora from AARP? She gave me some courage to come forward, but now I'm full steam ahead. So we're
Yep.
Thank
Nora's
you.
great. Nora never freaks me out either.
Thank you.
Okay, next on our list is John Wilson from ARP, who I believe is online. I see you there, John.
Thank you.
Thank you.
Senator Miller, Representative Doucette, and respected members of the Banking Committee. My name is John Wilson, and I am the volunteer state president of AARP Connecticut. I'm also a leader of the AARP Connecticut Volunteer Fraud Watch Team and a volunteer with the National AARP Fraud Helpline, where we receive 400 telephone calls a day from fraud victims. I am here to support House Bill 6990. AARP is a nonpartisan social mission organization with an age 50-plus membership of nearly 38 million nationwide and nearly 550,000 members here in Connecticut. As volunteers, we bring our fraud prevention presentations to communities across the state. We partner with state agencies, law enforcement, and nonprofits with expertise in fraud prevention to enhance our presentations. We are happy to accept invites from any of you to bring that presentation to your community. As you can tell by my introduction, AARP is deeply involved in fraud prevention, and for good reason. Criminals are increasingly targeting older adults for fraud using a variety of financial products and services such as gift cards, electronic payments, wire transfers, and cryptocurrencies. The Federal Trade Commission estimates that reporting is significantly underestimated. Criminals stole $158.3 billion from Americans in 2023. Of that figure, an estimated $61.5 billion was stolen from older adults. All ages are susceptible to fraud, but when the older adults are victimized, the impact is all too often financially catastrophic, emotionally devastating, and comes with significant health implications. Those are staggering figures, and the more that states do to combat financial crimes, the less damage criminals will be able to do to older residents. Increasingly, criminals are seeking payments in cryptocurrency. The reason is that cryptocurrency transactions do not pass through a bank or other institution, which otherwise might flag and stop suspicious activity before the transfer happens. Like wire transfers, crypto transfers cannot be reversed once the money is transferred. Law enforcement is often left without the tools it needs to intervene. I am no crypto expert, but I spend a significant amount of my time volunteering to help people avoid fraud and recover from it. The Federal Trade Commission reported in 2022 that consumers lost more money in scams through cryptocurrency than any other payment method in recent years. The report found that consumers lost over $1 billion in crypto to scams since 2021 alone, with a median reported individual loss of $2,600. We all know it can be much worse than that. I have personally spoken to fraud victims who have lost several $100,000 in cryptocurrency to scammers. House Bill 6990 amends existing statutes to include digital wallets and virtual currency within the scope of property subject to seizure and forfeiture under certain conditions. Among other things, it also details the conditions under which property may be returned to the owner, such as if the related criminal proceedings do not result in a guilty plea or verdict. AARP recommends that this bill be strengthened with additional language to help law enforcement support financial fraud victims. Such language has been proposed and supported by members of this committee in House Bill 5237, which would define digital currency in the penal code and allow for pre-conviction confiscation of digital wallets associated with thefts.
Thank you, John. Thank you. I don't know if you heard the buzzer, but your 3 minutes has elapsed. You can briefly sum up, and we'll see if there's any questions.
Well, the last thing I was going to say is more details can be found in my written testimony, and I appreciate the opportunity to testify.
Okay. Thank you, John, and thank you for your work and being part of the Red Coat Army of AARP volunteers, Nora's Army, John's Army, and the work you do is important. I was going to ask you, in terms of disclosures, we worked with AARP. We had a big bill a couple of years ago related to trying to tamp down on fraudulent transactions that happen out of banks. Now we're talking about the realm online, and AARP does a good job, I know, of trying to get the word out there, education of members and publications that get sent out, warning people. What do you think we could do in addition to that kind of stuff in terms of disclosure and warnings?
As the previous witness testified, letting people know that being a victim is not dumb. It is not stupid. We've got to let people know what she did, come out into the public and admit what happened. And she said, there's only 2 state troopers that are involved in this. We need more of that. We need more publication. We need more newspaper stories. And we need more people to tell their neighbors, tell their friends. As we say, if you can spot a scam, you can stop a scam.
Thank you. I agree. Representative Delnicki.
Yeah. Thank you, Mr. Chair, and thank you for your testimony. I want to ask, and this is technically not part of the bill, but you mentioned education. Is AARP available to go to senior center if any community that we represent? Because I hate to see anyone go through what we heard today. And I have to be perfectly candid, the cryptocurrency is the wild, wild west. And there's so many folks that are becoming victims to it. And there has to be basically a stake in the ground to stop this from happening to anyone hereafter. So my question to you is if any member of the committee here or in the legislature period wanted to have an event at a senior center in their community to educate people, are your folks available?
Yes, we are available. We have over 20 people who have been thoroughly trained to become presenters of fraud prevention. I myself probably do about 10 or 12 of these a year in Connecticut, and my colleagues do equally as many. So all you have to do is contact AARP, and we are more than happy to come and talk to senior centers, religious groups, anybody who wants to listen. We do it for free, and you do not need to be an AARP member to be in the audience. We want to get this message out to everyone. So certainly, please call.
And don't be bashful on taking a look at this legislation we have before us. And if you see anything that would make it a stronger bill, a stronger law, feel free to take a look, have your folks take a look at it, because I know you have a legal staff to see what improvements could be made above and beyond what we've actually got here. Thank you, Mr. Chair.
Thank you. Rep. Foster.
Thank you so much, Mr. Chair. I want to first thank you for doing those educations. We actually had the detectives who were previously mentioned, Detective Hogan, came to the senior center in my district. We had like 35 people attend, and every once in a while you would watch someone's facial expression and they were like, oh, I think I might have did that. You know, like people were, or I've received text messages that I knew were these pig butchering, phishing, sort of like looking for victims sorts of scams. So I think we need to make sure that our colleagues are getting this message out. AARP is doing training. The state police can offer these trainings if they're requested. I want to ask you a little bit about what we should be doing about when we're seizing assets and victims restitution. One of the things that I've come to learn in my advocacy on this bill is that oftentimes there are these like e-wallets that are associated with not just a single crime, but lots of different criminal activities. And I'd like you to sort of speak from the senior perspective here, because what I envision happening, and this is the wild, wild west is such a good metaphor, because I'm sort of imagining like cowboys of ones and zeros trying to sort of solve all these crimes. But what we're looking at here is like sometimes there could be a situation where you have asset forfeiture of a wallet, and you can identify through blockchain analytics and analytics on the account that there is likely other victims' money held in that account, because what's happening in these crimes is they're not just going after one victim, they're going after multiple victims at a time. And we also heard that there's this sense of shame. So people have been victims of the crime and maybe they're not reporting it. So someone comes forward, they find the contaminated wallet, and we create a system where asset forfeiture is possible and there's a victims restitution fund. Like theoretically, I'd love to see a way where we can get to victim notification where we have this contaminated wallet. We think that we've been able to trace back other victims' money that's in the wallet, and we can notify them. We think that you were a victim of this crime. We've traced money you sent to this criminal wallet. What can we do about getting you your money back? And I'm just curious if you've heard that in the advocacy and work that you've been doing, are like, for as many victims that we know of, how often do you think there are victims that we do not know of? And do you think that that might be a promising way for us to help get people their money back, even if they've not been able to sort of report and find it? I'm hoping, I'm optimistic this is a better question for law enforcement in that way, but I think that we might be able to make more people whole if we allow for the seizure of wallets that are associated with criminal activity, and noticing of potential other victims, even if they're not the originally identified one. So do you have any thoughts?
Yes, one of the advantages and the disadvantages of cryptocurrency is that the transactions are anonymous. It is extremely difficult to trace money in a digital wallet. As I said in my testimony, I'm not an expert in cryptocurrency, but having talked to people about this, it is extremely difficult once that money is transferred. And it is so easy to put money into a digital wallet. All you need to do is look for a digital ATM. They're all over town. Go in and feed dollars into it, and they're gone. AARP is very active with the International Association of Financial Crimes Investigators. And a number of us every year go to the conference where we hear stories, not just stories, but we hear techniques that are being used. But it's very difficult to get this money back because of the anonymity. It's an advantage, but as far as all of us in this room are concerned, it's a big disadvantage too.
And I think that there are cases where the police are able to say, we believe that they can, using blockchain analytics, that I think that there's ways for them to appropriately identify sources of other money in contaminated wallets. So one of the things that I've encouraged in my testimony that I've submitted is that we create definitions of cold storage wallets, allow for the seizure of those wallets that are associated with criminal activities, and then we can create noticing for other victims whose money ended up in those locations, but also for victims who we are unable to trace to where it goes, that there's a fund that the courts are then administering, which is the way asset forfeiture happens right now, where they can create, the opportunity to make these victims whole in whatever way is possible. So, it's just so tragic to hear about how many people are not able to see remedy. But I do know that, we've sort of established that we need more people doing this work from a law enforcement perspective. We certainly need to make sure that those law enforcement officers have access to every technology necessary that they need to counteract the bad actors. And we need to sort of create a system where we are able to forfeit assets associated with criminal activity and use that to make whole the victims that we have in our state. Hoping many other neighboring states are going to start doing this good work too, because the more people counterbalancing the criminal work here, the more likely it is that our victims in Connecticut are able to be made whole, because those investigations are happening, not really here. They're happening in the internet. That is, that is everywhere. It's a pretty foreboding opponent in our work here. But I thank you so much for your testimony.
You're welcome. We're making progress. Unfortunately, it's slow, but we are making progress, as you pointed out.
Thank you, Rep. Foster. Seeing no further questions. Thank you, John, for your testimony today. Okay, we're going to move on. Switching gears. Next on my list, I see David Webb. Is David with us? I think David.
Yes.
Online. Yes.
Yeah. Thank you. Thank you so much, Mr. Chairman. Thank you, representatives. Thank you for the opportunity to speak remotely. I am here in support of Representative Hux's bill, House Bill 5849. Let me just say, by way of introduction, I, as a young man, worked in New York in investment banking, mergers and acquisitions. I was then with what was at that time the biggest private equity firm in the world. And then eventually ran hedge funds through the dot-com bubble and bust. And I was very good at that. And my clients included a former president of the New York Fed, a former U.S. Treasury Secretary. So I've worked at a high level in the financial system, and what I'm exposing to you here is that there has been a shift in certainty of control of financial assets within the financial system. For centuries, investors had the control. When we had stock certificates, we had certainty of control. Then the system was put through dematerialization, eliminating paper certificates. And what this allowed was a shifting of certainty of control of the property from the investors elsewhere in the financial system. And this is to the secured creditors of the intermediaries in the financial system. And this is done on a massive scale all the time. This is not a little bit of the time that this is done, it is all the time. And once the property has entered this use as collateral in the system, it is then used many times over through the first institution that receives it as collateral reuses that collateral. These collateral chains are very attenuated, so there are many claimants to the underlying property. Now, how this sounds very overwhelming, but let me make it very simple for people to understand this. If you question your intermediary, your broker, the first person you speak with may not understand this, but the reality is that in the event of insolvency of an intermediary in the financial system, the investor has no right to take their securities back out of that insolvency. That is how you know that it's no longer your property. If you don't have the right to take the property back out of insolvency of the intermediary, now this is the key thing, it's not your insolvency, it's the insolvency of some institution within the system. So that is a clear, bright line. That's how you know that it is no longer your property. Now, how do we know that?
Good. Thank you. Your 3 minutes has elapsed. If you could just summarize briefly, I'm sure there will be a few questions. We can continue.
Okay. Okay. Well, the second point is we know that because of a definitive primary source document, a response of the New York Fed to a questionnaire sent by the EU when the EU was being pressured to conform to this system. And the Fed explains that the investor is always vulnerable to insolvency of the intermediary, and that even if accounts are segregated, think of institutional accounts, they are also vulnerable in the same way. So this is not just an issue for small investors. This is an issue, it's a societal issue. It is the state pension plans. It's all investment funds. So I'm happy to answer questions. Absolutely. Thank you for the opportunity to speak with you.
Thank you. Thank you. Appreciate your testimony. Where are you joining us from today?
I'm in Sweden, and I have knee surgery coming, so I can't travel at this point.
Really? Okay. Yeah, that might want to, not in a while at least, have we had international testimony. So that's very interesting. And what, you're not representing a client here today. What is your, you said you've been in the industry
Yes.
for quite a while, but what is your connection or interest in this specific issue?
I am speaking as a human being. I don't represent some entity. I represent myself, but I am doing this out of concern for people.
Okay. You know, I looked at this a little closer. You know, I thank Representative Hoxha for submitting the bill. It's a very straightforward, and I know there's some history to it, and I know It goes to the Uniform Law Commission. You know, as an attorney myself, it's been quite some years, but I took some UCC classes and law school, so it's I know it's convoluted. But if you boil it down, here's my question for you. Can you give us a real world example of either A, in the time that this change in Article 8 happened in, I think it was 1998 here in Connecticut. I think from what I read, I recall it was 1994 or something like that, that the Uniform Law Commissioners came out with this change, as they often do, to the UCC. Can you cite for us an example where this provision has been invoked and any individual shareholder has actually lost money or lost a claim to their securities?
Yes, absolutely. And thank you for the question. We have incredible exposition of this through the bankruptcy of Lehman Brothers. And what happened there was the moment that bankruptcy was filed, all client accounts were frozen in the bankruptcy. Now imagine you're in a financial meltdown. No one had access to their accounts. Now the Uniform Law Commission will say, well, no one lost money in Lehman Brothers. Now that is at best a misrepresentation of what happened. The retail accounts were sold after a period of a couple of months. Then people got access to their accounts again, but they had no access to their property during this very scary time. Now, the more significant thing that happened was, think big, sophisticated investors you would think would be able to protect themselves. The institutional clients of Lehman, what was happening there? Lehman was using their collateral, their treasury securities under swap contracts to finance Lehman. Now, that is not an unusual thing. That is what is happening all the time. And when Lehman filed bankruptcy, now think those firms needed that collateral to operate during the crisis. They lost all their collateral. Who was using the collateral? So Lehman was using it, but JP Morgan was the custodian for client assets and also the secured creditor that took their assets, knowing full well that they were client assets they were taking as the secured creditor in the crisis. Then there was these institutional clients worked for years trying to get their collateral back. 5 years after the bankruptcy of Lehman, there was a judgment in the Southern District Court of New York, Manhattan, and the bankruptcy judge found that JP Morgan was to keep the assets, did not need to return the assets, and that the only question was whether JP Morgan was entitled to do that. And the judgment says literally, Lehman is a member of the protected class, which means just the biggest banks have the super priority to take the collateral in a crisis. So it has absolutely been irrefutably demonstrated.
Okay, but let me bring it back a little bit, because I mean that's all very interesting as an intellectual exercise to talk about the morass of the financial institutions and the way that they function. I mean, we could talk about banks as we often do, and things that happen behind the scenes of the banking system and any other financial instruments. But my question for you was, did individual investors lose money? And are you saying that this is the venue that we should be talking about investor protection and not looking at SIPC, for instance, or actual consumer protection laws or venues that are designed, the FDIC in the banking realm? Are you saying that this is the venue that we should be fighting this battle, or is this more of, it's very esoteric, I think, in terms, and it's an interesting conversation, like I said, as an intellectual exercise to talk about how the financial system works. But again, we're here, to look at real consumer protection. So, somebody has a stake in a stock certificate and can put it on their wall or put it in their safe the same way they can gold bars, or we talk about NFTs and things like that. That's great. You have possession of your property. But my question for you is, are the safeguards that we have, things like SIPC, things like FDIC, inadequate to provide consumers protection against losing their money?
Yes. Okay. SIPC is wholly inadequate. SIPC protects no institutions whatsoever. So no pension funds, no investment funds. SIPC is basically an insurance scam. It provides an appearance of protection. It will protect no one in a systemic failure. The entire capitalization of SIPC is just a few $billion with a B. That is not going to protect anyone in a systemic failure. What has been done here is to legalize wrongdoing, to allow the use and this is in the history of implementing this, that they were very conscious of making it possible for the assets to be used wrongfully, systemically. I have to point out when people from the Uniform Law Commission say that this was about modernization or electronic trading, that this is just how a modern system has to work, they point back to the paperwork crisis in 1968 as the reason to do this. It's a very simple observation that the system worked just fine without this exception that was put into your law in 1998. It worked from 1968 to 1998 without this insertion into the Uniform Commercial Code, allowing the secured creditors to use the property without restriction and free of payment. That's what is being done. So this was very deliberately done. The system worked fine for 30 years before doing that. NASDAQ was formed in 1971. The system operated for 30 years before this was implemented in all 50 states. So this was about something other than the operation of a modern electronic security system. I am in Sweden. When Sweden was forced to dematerialize and go to an electronic system, they did it to keep specific direct records electronically of ownership of the securities. So it can be done. This was a choice that was made and implemented in state law in all 50 states quietly without people understanding what was being done. But you can know the intent by going to, you can see the explanation from the Fed itself, which I provided to you. We also know from how this operates, from what happened in the case of Lehman. And coming back to consumer protection, People care about their pension plans. People should care about the finances of their state. All of that is exposed to this. And this is a disingenuous statement of the Uniform Law Commission that no one lost any money in Lehman. Let me give you a very simple analogy. Let's say you come out of your house in the morning to get in your car and go to work, but your car is gone. And for 5 years, you do not have that car, and the police return it after 5 years. Does that mean your car was not stolen? You did not have the use of your property. That means it was stolen.
It's a, interesting analogy, interesting discussion. Again, I still come back to, show me harms that have been done, actual harms outside of just this discussion about the financial system generally, harms that have been done to Connecticut, either retail investors or even institutional investors, over the time that this has been in effect. I'm still not hearing it. And yes, my car was stolen out of my driveway. That happens. That happens throughout this state every day. So I agree with you there, but I don't know if the analogy is a good one. But let's move on. I'll see if any others have questions. Representative Hoxa?
Yes, thank you, Mr. Chairman. And thank you, David, for taking the time to appear before this committee on Zoom from Sweden. I know you were originally an American citizen. You have since moved to Sweden, hoping to find some, a different lifestyle there. But it sounds like from your previous statement that you sort of started seeing the same things happening in Sweden. It's unfortunate that we lost you as a citizen. But anyway, so my question is, let's start. I have a few, and if the good chairman wouldn't mind entertaining a few, allowing me to ask these a few questions to you. I know some committees are limited to just a couple, but I may have maybe 3 or 4 here, but some of them may be answered together. So let's start off with the first question, which is sort of like I'm going to ask it in the form of an analogy. The way you brought forth that analogy, I will sort of ask the question sort of in the same way. If, for example, let's say like a broker is sort of akin to a storage company. You entrust that brokerage the same way a person would entrust a storage company with the contents inside their garage, right? And that storage company, if you pay your bills, if you pay your monthly storage fee, does not have the right to sell the contents inside the storage container. So in that sense, would a brokerage have the right under current law here in Connecticut, as you know it, would a brokerage have the right to put up an individual customers, let's say myself, I bought some stocks through company brokerage X. Does that brokerage have the right to use those stocks and those assets of mine as collateral in one way or another? Through you, Mr. Chair.
Yes, thank you. That actually is not how it works. That's not how the plumbing works, because, and this is the subterfuge. There are these federal regulations about the lowest tier intermediary requiring that they keep the firm's assets separate from their client assets. So that's kind of like the misdirection. Watch this hand. We have this regulation saying that the broker cannot use the assets. The assets are not at your broker. That is the subterfuge. The assets are held at a higher level in these vast pools, so the segregation, the idea that the client assets are segregated, is just in the books and records at the lowest tier, the first tier intermediary. It is actually at the higher level that the assets are being used as collateral. And I would like to say I am a U.S. citizen. And I care very much about the U.S. And in fact, I have very, very deep roots in Connecticut.
Well, thank you for that. And through you, Mr. Chair, I'm glad that you clarified that because I didn't even, understand it to that extent. So, but the point being is that, prior to 1998, this wasn't an issue because according to what the bill would do if it were passed, is that it would return the UCC code back to its pre-1998 version, which essentially had, in the event, and as rare as it may be, and we can argue that, all day there's different, viewpoints on how, rare this event, what the rarity of this sort of event that would cause this to even become an issue in the first place is, in the event that a financial calamity happens to the point where this now, the subject matter becomes relevant, pre-1998 UCC Article 8, subsections A through C were such that the individual would be protected and property, as you said, which is what a stock is, or at least ought to be. I don't know if that has even changed, but it is your property, a stake you hold in a company on the stock, on the stock market. That property would be returned to its original owner, and any assets of the brokerage or those that had possession of your stocks and custodianship would be what the creditor would go after first, and not just first, but only. So that was pre-1998. Is that a correct characterization of pre-1998 UCC code? Through you, Mr. Chair.
Yes, I have to say, I'm not an expert on exactly how the code read before 98, but I will say when these changes were promulgated in the 90s, beginning in 94, the statement, there was essentially a statement alongside that by the Uniform Law Commission asserting that what this did was to give the entitlement holders, this is the new legal concept that was created that hadn't existed in centuries of securities law. We now have an entitlement to the property. It's no longer a chattel as it was as a stock certificate. So, but the assurance was that the entitlement holders have priority over the secured creditors of the intermediary. And this is what the Uniform Law Commission will read in testimony. And that is in the first instance in 8511. But then this exception was inserted there. This is what your bill is seeking to delete, that gives the secured creditors of the intermediary priority if they have control. And this is what I'm explaining. Control is achieved all the time by the secured creditors. Control is a concept from bankruptcy law, which means that the creditor has the ability to act on the security. Now, what we know with this dematerialized system, we know that we, the public, even the big investors, do not have control because they're no longer certificates, they're dematerialized, they're held elsewhere in the system. And the system is designed so that the secured creditors have control 100% of the time. So the bill is actually very elegant because it would just strike that exception so that now the language would read that the entitlement holders have priority to their own assets, which is what they were promised. And this is what the legislators were promised when they enacted this in 1998 in Connecticut. And it is elegant because nothing changes. It only matters in the event of insolvency, and then you want to have made this change. All the plumbing of the system continues to operate. In fact, all contracts continue to operate under the place of law in those contracts. But for the first time, institutions, the state itself, the pension plans will have the possibility of setting the place of law in the state of Connecticut for their contracts so that those entities have priority to their own assets.
Thank you, David. And that's all I have, Mr. Chair. Thank you.
All right. Seeing no further questions, thank you, David, for your testimony.
Thank you.
Okay, next on our list, another David Heiss, who's here with us today. Welcome, David.
Thank you very much.
He has written a book about the subject. He has produced a documentary about this subject. He cares about this for individuals and Americans and people around the world. He's an amazing citizen. And so I just became aware of his cause only about 6 weeks ago. Again, I'm only representing myself as an individual. So I'm a chartered financial analyst. Also was a former CPA. I founded and managed two different mutual funds for a decade and a half, having achieved $1.6 billion in assets. One of these funds was actually a bearish fund, and the other one was a international bond fund. So I've been on CNBC and Bloomberg more than 100 times. Oftentimes when I came on, I debated other Wall Street strategists about the overall market. I ended up predicting the 87 crash, the 00 to 02 crash, as well as the 08 crash. Hank Paulson warned about outright cataclysm. He was the Secretary of Treasury back in 08. And therefore got Congress to have a massive bailout, but he warned about the danger to the financial system. There's still a huge risk to an ultimate financial cataclysm where the biggest of all these financial institutions are wiped out. And Mr. Chairman, you are correct about how this has not really influenced the individual investor in Connecticut up till now. What we are worried about is the plumbing is set up with this legislation and the current Uniform Commercial Code that if we do get to a cataclysmic situation, which is certainly a possibility, that the law will not protect the little guy investor, and it will essentially allow bailout to go to the secured creditors of these massive financial institutions. So we now have $1 quadrillion of derivatives in the system. Warren Buffett called these instruments of mass financial destruction. So I had to look up what a quadrillion was. Well, quadrillion is 1,000 trillion. A trillion is 31,800 years of individual seconds. Okay, so that's a lot of money. So there is certainly a massive chance of these financial institutions potentially going bust. So restoring clear priority to investors, to their own assets, is important to me. It's important to all of society. It's important to the state of Connecticut. It's important to the United States of America and to the whole world. This current law is an abomination. And frankly, what's been proposed is a very simple fix to it. And we can outline specifically the exception. And it essentially, the way it exists now,
Thank you, sir. Your time, if you could just briefly
Yeah.
wrap up.
what exists now allows for a bailout from the common man to secured creditors, the financial institutions, and we can't have that. Thank you.
Thank you, sir. And where are you joining us from today? Are you from
From
Connecticut?
From Dallas, Texas.
Dallas, Texas. Okay. And same question for you that I asked to the previous gentleman. Are you representing a client in this, or are you just, as an individual testifying in your own capacity?
An ordinary citizen.
Okay. And again, I still am searching. It sounds like there is no, there may have been some issues that touch upon this generally that transpired in the 08, 09 financial crisis. But do you have any other past examples, or give me a real world example about what we're talking about here that could happen? It sounds to me like we're talking about a calamity like the 08 financial crisis, or even worse. That's what you're talking about here. Not again. I mean, we had a woman sat here before us. I think you were here, who was the victim of a financial fraud within the last 12 months, and she told us exactly how it went down. So it sounds like we don't have any examples of that here. What you're talking about is a systemic failure of a calamitous nature. Is that what we're talking about here?
That's exactly right. But that does not mean that this should be ignored, because the financial institutions essentially are being prepared in case something like this happens.
Thank you. Any questions? Rep. Hoxa.
Thank you, Mr. Chairman. As with David, I have a couple questions for the testifier today. I will, try to be as efficient with those questions as possible. So first question, thank you, Mr. Tice, for coming here all the way from Texas. I know that, it's for an issue like this, it's pretty difficult to find, expert witnesses or expert, testifiers that don't really understand the subject matter, which is why sometimes it's necessary to, have to look outside of Connecticut to find, or outside of any particular state to find an expert on a particular subject, as I know that, it is a very, as the chairman described it, esoteric in some sense to know about these things. And I certainly am not an expert. I wasn't an expert. I'm not an expert on it now, but I was told enough about this issue to understand that it was an issue and that it needed to be addressed. So with that said, it is difficult to come up with a real world example on a micro level of how this could affect the consumer, I guess, the stockholder, the property owner. But it is very easy to see how it can, if like the domino that increases in size. Each time the next one falls, you can use that sort of kinetic energy, right, to bring down a building if the incremental gain is such that it could result in that. So it's sort of the same thing, but in reverse. If a major financial calamity happens, it will eventually trickle down to everyone, regardless of whether you own stocks or not. But can you characterize specifically how that would happen? Give us a scenario. So like, for example, in 08, we all, were around for that. That wasn't, too long ago. I think a lot, we all remember how that went down and how it affected people on an individual level. The government came in and created a whole lot of cash to bail a lot of these institutions out. And, some serious calamity, I guess, was avoided. But in the event that doesn't happen, can you tell us how that would play out right up to the individual level who owns these stocks that are now gone?
Okay, so I think I understood your question. Let's say there is a cataclysm. Okay, let's say that the market does decline by 60%. and essentially the big banks get in trouble, the Morgan Stanleys of the world, the Charles Schwabs of the world, et cetera. Okay, so there's a number of Connecticut's constituents that have $400,000 in their pension fund. Okay, so in a crash, that $400,000, goes to maybe $150,000. Well, that $150,000 could potentially be seized by those secured creditors, and therefore you guys are going to have a ton of pissed off constituents, excuse my French, because they think they've got $150,000, now they have zero.
I see. So, we have a pension fund here at the Capitol. The state employees have with a pension that they expect to collect on after a certain amount of years of it being vested. So would something like that, like even like state workers, elected officials, government workers, would be at risk to this sort of potential calamity through you, Mr. Chair?
Exactly. And then there will be discussion about that, and everybody's going to be saying, how in the world did that happen? And they're going to look to the Uniform Commercial Code, and they're going to say that the secured creditors of those institutions were entitled to those assets over those owners. And they're going to say, how in the world did that happen? And frankly, this is a major scam that's been perpetrated on the Uniform Commercial Code through state legislators over, a decade, between 1994 to 2001. And I read about this, and you can watch the documentary. There was a second documentary about this. I mean, this is the biggest travesty of justice I've ever seen in my life.
And lastly, through you, Mr. Chair, I've had a couple people reach out in the last week or so about this bill and to talk to me about it. And one individual said that this sort of situation would only apply to something called a margin account. Can you explain what a margin account is and why somebody would think that this only applies to a margin account? Through you, Mr. Chair.
Well, this is a complete misdirection from the financial industry. David Webb and Don Grande, who's testifying next, Don's a lawyer. He can explain this better than I can. But the margin account has to do with individual borrowing against an individual's account to buy more securities. And this is an individual contract, and this has nothing to do with this particular legislation.
Thank you, David. I appreciate you coming here all the way from Dallas, Texas. That's all the questions I have, Mr. Chair. Thank you. Thank you, David.
Thank you, Representative. Okay, seeing no further questions. Appreciate your testimony, sir. Okay, next, moving on, James Showolf. Mr. Showolf is here. Thank you. No, you're next on my list, so.
Okay, microphone on? I think it is. Okay, good morning. I'm Jim Schulwolf. I'm from West Hartford, Connecticut, so I didn't have to travel anywhere to get here. I'm a partner at Shipman and Goodwin here in Hartford. I practice in the area of UCC law. I don't give myself too much credit, but I think I recognize as one of the leading UCC lawyers in the state, and I'm here testifying in opposition to this bill, both individually and on behalf of the Uniform Law Commission Connecticut delegation. So I don't really have time to refute all the stuff that's been said by the last two witnesses, but let me try to simplify and explain why I and the ULC and folks should strongly be opposed to this bill. It's an unnecessary bill, and it results in a lose-lose situation for residents of Connecticut. in two principal ways. The first one is it claims to address a problem which you've heard described in cataclysmic terms that really derives from a conspiracy theory. But the problem doesn't actually exist because the law adequately protects investors, people like you and me who own securities. And I'll get to that in a second. So it's trying to solve a problem that isn't actually there. The second lose is that if it's passed in the form proposed, it will actually create a new problem for Connecticut investors, which doesn't exist today, by denying them access to capital that they would otherwise be able to obtain by using their securities, their own property, your property, my property, to borrow money. So as a result, we would be an outlier among the states, and we would be so to the detriment of our citizens. Now, why is that so? First, the law as it is perfectly protects investors. 8511A, which you've heard cited here, clearly gives investors priority over creditors of a broker-dealer if a broker-dealer becomes insolvent. That is the core of the law. The exception that has been referenced and is proposed to be eliminated from the bill is a very limited exception, right? It applies only to situations where you and I as individuals or people use our securities as collateral to borrow a loan. And the key, as Mr. Webb noted, is that there has to be control. The creditor gets priority if and only if they have quote unquote control over the securities. And control is a very specific concept in the UCC. It requires a voluntary act by the borrower in order to grant control. They have to either physically deliver securities or they have to sign an agreement which gives the creditor certain rights. If you don't have that, there is no scenario, zero, under which the secured creditor can get control over the securities. So when Mr. Webb says, this exception was put in as a means to give the secured creditors control, that is not accurate. The only way that a secured creditor can get control over your securities or mine is if I agree to give it to them. And if I don't agree, they don't have control. And the basic rule in 8511A, where you and I do have priority, is the one that wins. So, what happens as a result? I mean, I'm going to use Representative Hoxie. You asked a good question. I know my time is up. About the storage company and whether the broker or the storage company could grant access to my collateral to somebody else. And we heard a long explanation, but the simple answer in one word is no, they cannot do that. Period. End of story. I could say more. I'm sure you guys have questions. I don't want to go on, beyond my time limit. But bottom line, this bill doesn't accomplish anything. It hurts the residents of Connecticut, and it should be opposed. Thank you.
Thank you. Appreciate you coming today from West Hartford, and that's fine too. We appreciate having you. And thank you for your service on the Uniform Law Commission. Which committees do you serve on? How long have you done that?
So I'm actually not a commissioner myself. I've been asked by the commissioners to testify on their behalf, given my expertise in the general UCC area.
See, and do we have? I know we have the CBA. Is there a local section? I myself am a member of the real property section. Do you guys have different sections?
The ULC is a national organization composed of commissioners from each of the 50 states whose mission is to focus on uniform laws, and they meet as a group. In various points, they have committees and working groups on different proposed uniform laws. That's the mechanism by which uniform laws are adopted or amended. I note that these folks here are trying to amend a uniform law, but they've never gone to the Uniform Law Commission, which would be the normal place you would do that. But each state has its own commissioners who are actually appointed by the governor and serve at the governor's pleasure.
And that was going to be my next question. Are you aware of anything at the commission happening right now on this topic?
Well, the only thing that's happened at the commission is that they've taken notice of not only this bill, but the comparable versions that have been introduced in, I think, 8 other states and passed in none. And the commission, again, for the reasons that I've stated, is opposing all of these bills and again, trying to counteract the testimony that's been given by my 2 predecessors, and I suspect by the person coming after me, that, again, in our view, really don't accurately state what the law is and what the problem is, or how this bill would solve it, which, again, from our perspective, it would not.
Okay, and thank you for pointing out, the definition of control. Is that defined in Article 8 or is that Article 9 with respect to security interests that you mentioned?
Yeah, it
previously?
actually, it's a great question. It actually is defined in Article 9, but it applies both to Article 8 and Article 9. Control is really the means by which a secured creditor establishes what's called priority, which is, who gets first dibs if collateral needs to be liquidated. And control applies to a variety of things. Deposit accounts, for example, is one. If I am a lender and I'm taking a security interest in your deposit account, the way I have to do that is by what's called control. And again, you as the debtor have to actually voluntarily sign something that gives me that right. I can't unilaterally take it. It also applies to securities as well as a couple of other categories. So it's a very specific concept that has a particular purpose and again, a very limited purpose for that effect.
Yeah, thank you for pointing that out because, again, you reminded me, again, back to 25 years ago in my secured transactions class at UConn Law, that these articles are often interwoven, especially Article 9. And what we're talking about here is a party taking a secured interest in property, which is governed by Article 9. So while I agree with Mr. Webb that this is as he said, an elegant solution, as a legislator, I have a bill that's only 21 lines, which is wonderful for me because I can read it in the hallway and decide how I'm going to vote on it. Your point is a good one because there is a lot more to these issues of security interests and control. Again, we're getting way too in the weeds, I believe, here because my question to Mr. Webb and the other gentleman, and I'll ask it of you as well. I mean, what protections exist in existing law? You mentioned one that already exists in Article 8. What protections exist in existing law if I, as let's just say a retail institutional investor, were concerned about my securities and my assets at a financial institution?
Yeah, so let me answer that and then make one other observation, if I may. So the protection in Article 8/511 is the main protection for not only the institutional investor, but the individual investor with respect to establishing priority. There are other rules that govern, how I can transfer securities, but in terms of priority, this is the main rule that establishes clearly that, again, in the situation of the insolvency of a broker-dealer, I, as the individual security holder, have priority over the creditor unless, we fit into that very limited exception. The other point I wanted to make was, I know, and you alluded to it, that Mr. Webb referred to it as an elegant solution. I would disagree with that for the reason that it's not a solution. It doesn't solve the problem that he purports to be concerned with because, again, it's a very limited circumstance to which Section B applies. And it's a circumstance where you would expect as a borrower, right, or as an individual, that if you went to get a loan and the lender said, I want or I need X as collateral and X was your securities, and you agreed to give that to the lender, you would expect, as Mr. Hawks has said, that, as long as you pay the lender back, you get your securities back. And that's exactly what happens. And you wind up right back in 8511A where you have protection. If you don't pay back, like any other loan, you would expect the lender to come in and say, okay, I took this collateral, I'm going to liquidate it, foreclose on it, et cetera. But the only reason they can do that is because I gave them the right to do that when I signed the agreement. If I didn't give them that right, they could not touch those securities in any way, shape, or form because 811A, 511A protects it. So I guess it's a long-winded way of saying that's where the protection for the investor comes in, and that's not affected at all by this proposed bill. If anything, it's weakened.
Senator Miller online has a question.
Sorry, I'm going to turn around so I can see you.
Thank you, Mr. Chair, and thank you for your testimony. It was good to have a testimony that opposed what we're hearing here today. So I have a question regarding the control. Is it certainty of control? You said that it couldn't happen unless someone signs an agreement. Do you know, is that agreement a single page in a contract? Or is it hidden? It could be hidden in a contract.
I apologize for away from you.
Oh, you don't have to turn around to look at me.
Actually, I can see you on the monitor. Sorry about that. So that's a great question. Typically, control is given by a separate standalone agreement. So if in a securities context, it's not going to be buried on page 52 of a contract. It's not going to give you control. There's going to be an agreement if it relates to, in a broker-dealer case, a securities account that's actually called securities account control agreement. And it's typically about a maybe 4 to 5 page agreement. And I will admit it has a lot of legal boilerplate in it. Unfortunately, we can't do much about that, but it has one significant element, which is the thing that grants control, which is where I say that, again, if I default, if I fail to pay, then I agree that my lender can tell the broker-dealer, can give instructions to the broker-dealer as to what to do with the securities. But until that point, I'm the only one who can give instructions to the broker-dealer by agreeing that if I default, the lender can step in. That is the essence of how control is granted, right? And that is done through a separate agreement, again, usually about 4 or 5 pages that contains that provision, as well as, other standard provisions. So no, it would never be hidden or buried somewhere in the middle of a long contract.
So is giving that permission optional?
It is.
It is optional. So I don't have to sign that agreement.
Right. Now,
in order, okay.
Right. In practice, right, and if I'm a lender, I'm trying to get as much collateral as I can, right? Bargain with you for what you're going to give me. So if you don't agree, and this is part of the problem with the proposed bill, if you don't agree to give me the collateral I want or all of it, then the question for you is, are you going to make the loan? And if the lender, as a result of somebody not being willing to give collateral, says, okay, well, if you're not going to do that, I'm going to make the loan, that has hurt you because you've now lost the access to that capital that you might have needed, because you're not either willing to give it, or the lender is not willing to take it because, again, if you default, they might not be able to access it, in order to pay back their loan. So the answer is you don't have to give that collateral. That's completely between you and the lender. But if you don't give it, there's a risk that you might not get the loan that you're hoping to get.
All right. Thank you, Mr. Chair.
Thank you. Anyone else? Representative Hoxha.
Thank you, Mr. Chairman. And through you, a few questions for Mr. I'm sorry, how do you pronounce your last name?
Schulwolf.
Schulwolf. Okay. Thank you, Mr. Schulwolf. In your in what you were just describing to Senator Miller there, who you used the word you? Who are you in that scenario that you were just describing to her through you, Mr. Chair?
Oh, okay. So let's use different words. So if I'm the owner of securities, right? So I'm the customer or the borrower, the entitlement holder, any of the above, right? That's me. And you, let's say you, Representative Hoxer, were a lender, right? And so the question was, do I have to give you a security interest in my securities and give you, control over under the UCC as as the borrower? And the answer is I don't. That's between you and I as we're going to bargain for it. If I don't, hopefully that's still okay for me to get the loan, but you may turn around and say, yeah, without that collateral, I'm not going to give it to you. So that's what I was referring to. But again, coming back, I still have to voluntarily agree to give you that control. Otherwise, you don't have it.
Okay, so when an institution looks to borrow money from a creditor, you're saying that creditor now needs to look through the books of that institution and see who owns stock or securities through that institution and ask each one of them individually if it's okay for that institution to borrow money?
No. No. So if you're saying if an institution wants to borrow money?
Correct, because in this scenario, I, as a stockholder, I'm not looking to borrow any money.
Right. So if I haven't given the institution, which is I assume we're referring to a broker dealer, or not, or
I'm sorry, repeat yourself again, please.
So when we say let me say it a different way. If I haven't given the institution control over my securities, right, I'm still number one in the priority order. They don't have the right to take control over those securities, right? So the system is not set up, as was alluded to earlier, so that somehow they can, magically take control over my property, my securities. They can't.
Okay, I understand you're saying that, but I'm going back to the scenario that I believe you were describing it in this way, unless you weren't, and you were describing a situation between a stockholder, a property holder, in this case an entitlement holder, and a big lender. We're talking about the intermediary. At least that's what I'm talking about. So, okay. So now for the intermediary, you are saying there is no scenario in which they can leverage the stocks they have under their custodianship, the securities they have under their custodianship, without the individual stockholder signing off that that's okay for them to use their stocks as leverage for credit. You're saying there's no scenario in which that can occur without the written consent of each individual stockholder.
Yeah. So unless I've given control over the securities to the broker dealer, they have no right to, pledge it to somebody else, right? And even if they were to try to do that, again, 8511A provides that as the entitlement holder, I have priority over the creditor. You're not even in 811B, or 511B, which is the one that they're proposing to eliminate. You're not even there.
So the section in my bill that I am addressing is, so I'm trying to understand, why do you have a problem with the bill in the first place? If the section that I am addressing is not the one in which this scenario falls under.
Yeah, because
So I guess what I'm trying to ask, I'm sorry, through you, Mr. Chair. I guess what I'm trying to ask is the subsection of the articles that I am looking to switch to pre-1998 levels. What was it about that made it switch to what it currently is in the first place? What issue, from your perspective, arose in 1998 all over the country that made it so that that order needed to be switched? Why wasn't it okay the way it was before?
Right. Well, again, let's go back. The order wasn't switched. In general, the order was switched in a very, very limited scenario, right? And it was switched all over the country, I think. Again, I wasn't part of that process, but I think the rationale for it was that there are circumstances where, again, in the normal course, and again, um, in the normal course of things, people were using their securities to do things like borrow margin loans, borrow money for short sales, things like that. And they pledged their securities as collateral. And, what this section is intended to do, I think, is just simply provide a mechanism that says if you do that, if you voluntarily do that, in the same way as if you're borrowing from a lender, from a non-intermediary, from a regular lender using other assets, it's just establishing what the marketplace would expect to be the priority order in that limited circumstance, which would be that, the creditor, the secured creditor, having taken your securities as collateral, and again, you're voluntarily having given them control in that limited circumstance, and only that limited circumstance, they would have priority. Every other circumstance, including, once you've paid the loan back, or once you've satisfied, paid the margin loan back, then you're right back to where you were. So it's almost like draw a very little box around that limited circumstance. That's what they were trying to get at, and that's worked. I mean, that system has worked. It worked before 1998. It's worked since 1998. As there really aren't concrete examples of circumstances where the investors lost out. Even in Lehman Brothers, the investors did get their money back, did get their securities back quickly, which was, probably pretty miraculous given the scope of that, of that bankruptcy. And again, bankruptcy is a whole other world. So it's, it's not limited to what's in 8511. So that's why, because I just think that, again, and I think the general view of, the ULC and most practitioners in the field is that that's a very limited purpose exception. It's not in any way, and never was, intended to give, to shift the entire system so that the secured creditors have control. And in fact, it doesn't do that. It's a very, very, very limited circumstance, and there's no need to change it because it's so limited. It doesn't solve the problem.
One last question, Mr. Chairman. Okay, so you keep talking about this limited circumstance, but I've yet to really hear an example of what that limited circumstance would be. Before you sort of characterized the last the two speakers that spoke before you as being conspiracy theorists, and I don't understand what is it about the way the UCC codes were before 1998 that sparked a 50-state, a nationwide change to be what they currently are. But the conspiracy view is, to bring it back to what it was before 1998 is being labeled as the conspiracy theorist view. So prior to 1998, everybody was a conspiracy theorist in the UCC codes being the way they were. But after 1998, some enlightened people made it to the way they are now. And so prior to 1998, there was, I guess, everybody was wrong. All 50 states were wrong in the way that they were doing business. And all of a sudden, things are changed to what they are right now. But those that believe that they should have stayed the way that they were prior to 1998 are the conspiracy theorists. Is that what you're saying? Is that how you are characterizing the motivations behind trying to address what this bill is trying to address? Through you, Mr. Chair.
I wouldn't say it that way. I think things work well. Again, the world was different for a long time in terms of we had paper securities, we got stock certificates, we put them in our vault, et cetera. As again, without giving too much history, as there were more offerings, more certificates, it became essentially impossible to manage that. So the what's called the indirect holding system was established, and that was a lot of what was done in 94, and obviously we adopted it in 97. And it's not that things weren't working well at the time. They probably were. Again, it's a long time ago. But a revision was needed to make things work better given, the realities of how securities were traded. And so this provision, subsection B was put in again to, to cover a very, very limited circumstance, not in any way to, surreptitiously change the system or shift control from one group to another, because again, 511A maintains the control where it's supposed to be maintained with, with you and I as the consumers. What we've seen recently, and again, I mean, maybe I won't characterize it as a conspiracy theory, but what's behind this, at least in the literature that we've seen in the other testimony, is this, view that there's going to be some cataclysm that's caused by, collusion among the, various, banks, et cetera, that will wind up, because of this shift, with them being able to take over your securities and my securities and Representative Doucette's securities, et cetera. And that's just not accurate. Even if that type of cataclysm could happen, and it would have to be much, much, much worse than, what we saw in 98. And it would require, institutions, et cetera, who compete with each other every day for your business and mine, to all of a sudden get together and say, hey, we're going to take everybody's securities. How they're going to divide them up, who knows? But you're talking about a cataclysm of that level. But even with that, even if that, could happen, the system works as it is now. A, provides the proper protection. B, again, very limited circumstance, doesn't change the rules. And so, the system would work again. And that's really the issue, is that the bill doesn't accomplish anything for investors, right? It doesn't provide a benefit for investors, because the protection is already there. And if anything, again, eliminating B potentially, causes a detriment to investors, because where it affects you and I as a security holder is that it makes it less likely that a lender that a creditor would give credit to us, because they don't have the priority that they would normally expect in the marketplace. And so so they're not likely to do that. So we lose the benefit of being able to utilize our securities as collateral. There's no systemic, there's no giant shift there, because again, the only time B is in effect is if I actually say, yeah, I'll grant you control. If I don't do that, it's a complete non-issue. So that's why I would oppose it.
Thank you, Mr. Chairman, and Mr. Schulwolf, thank you for taking my questions. As promised, that was my last question. I will just close off by simply just saying that I still don't have a clear understanding based off of what you said, and especially when given the opportunity to explain that little carved out scenario that you think that that this would apply to. I still don't have a clear understanding of what that little carved out scenario is, and I still don't have a clear understanding of what the compulsion was to enact this change back in 1998 across 50 states, or up to 1998. Connecticut was one of the last states to enact this, which implies that prior to that, in the years prior to that, there was other states that were making this change. I still don't have an answer on those two things.
Yeah, let me say, if I can, on the last point, the way the uniform law process generally works, right, is the Uniform Law Commission comes up with, and it's not just coming up with there are proposals, there are study groups, there are drafting committees. It's a very involved process to come up with a proposed uniform law. Once that uniform law is, finalized, it has to be approved by the full commission. It also typically has to be approved by the American Law Institute. And along the way, there will have been significant input from, the American Bar Association, consumer groups, industry groups, et cetera. It's a long and very thorough and detailed process. Once that happens, and only once that happens, the proposed uniform law goes to and is introduced in the legislatures of every state, and it has to pass the legislature in every state. Now, again, the purpose of uniform laws is to provide consistency and uniformity across the country so that, we don't have to worry about whether Kansas law is really different or Delaware's law is really different, in certain areas. And so when it's introduced in the various legislatures, the legislature, at least in Connecticut, typically appoints a study group to study it and adapt it for Connecticut purposes. And again, that same process comes about. Consumer groups can testify, investor groups, you name it. So by the time it gets through the legislature and some states approve them faster than others, it's been vetted really, really, really thoroughly by a lot of people. It's not a process that's taken lightly. So, for when Connecticut adopted it, and we often are among the later ones to adopt provisions because we look at them very carefully. I was, involved in revised Article 9 around in 2000, and we had a lot of meetings where consumer groups, wanted revisions, and other groups, and these were studied very carefully before it finally got to a form that was approved by the legislature. So that's the process. And, it was done because, as a result of that research, right, and looking at what the world was like at that point, it was decided that, this was necessary. And the reality is it's worked. It's worked since 1998. And, to go back, right, firstly, to do that, again, one would think that an amendment like this would have been brought to the Uniform Law Commission. It never has been. And so, I don't know, to me, that says something. But this was a whole process, and it was thought out, and it was deemed necessary for the reasons I've said. And the reality is it's worked. And it continues to work, and it will continue to work. And there aren't any concrete examples, fortunately, where it hasn't worked. So, happy to talk further offline, but that's kind of as good a history as I can give, and that's the bottom line.
Okay, sir. Well, thank you. It sounds like, what I wanted to get out of that question, probably the best nugget in that was the world has changed. And yes, the world has changed. I don't specifically know what about the world changed that compelled the UCC to commission to make this adjustment in 1998. But yeah, I would be happy to learn, more about what that was, what in the world had changed back in 1998, and take this conversation with you offline if you'd like. Thank you.
Sure.
Thank you, Mr. Chair. That's all.
Thank you, Representative. And I think the witness did explain that, and I appreciate the explanation about the ULC. And I will point out too, in terms of our procedure here, that is ordinarily the domain of the Judiciary Committee. We sort of poached this tiny discrete issue related to our cognizance. You had brought it forward as a proposed bill, and as a member of the committee, we're happy to have a hearing on it. I'm not sure if my friends upstairs on the Judiciary Committee would like us poaching their issues. And I'll point out too that we have on Monday, we have a hearing in Judiciary for various amendments to the UCC. We have one bill that is 163 pages of amendments to the UCC. And I know, again, having, studied a little bit in law school, that the Attorney Schulwolf is correct, that these take a really long time. And they are, sorry for law nerds mostly, an interesting process to get involved in. And I appreciate, you have clarified quite a bit for me, I think. And I appreciate your testimony today.
Okay, thanks.
Thank you. All right. Next is Don Grande, who is online. Hello, Don. Please proceed. Don, you're on mute. Still on mute. There you go.
Sorry about that. Thank you, Chairman Doucette, Chairman Miller, members of the committee. My name's Don Grande. I'm an attorney in private practice in North Dakota. I'm here representing True North Public Policy, which is a public policy consulting firm that we formed to focus on this issue specifically. And I did submit written testimony that gives a lot more detail as to our position and has some additional resources at the end of that testimony. But in the interest of time and in the interest of what the committee's already sat through with this issue, I'm going to be very, very brief, but I do want to address a couple of things. I have a sense that that the waters have been muddied a little bit here. So let me just clarify. All due respect to the prior speaker, 8511B has absolutely nothing to do with margin accounts. Absolutely nothing. And I can prove that by what's in your statute. I can prove it by what the drafting committee said. But essentially, it comes down to this, is 8511B is a priority clause. It's a clause, a priority clause is only needed if you've got two or more entities that have a claim to the same asset, right? So in the margin account example, the investor has already pledged his securities to the broker for a loan. He no longer has a claim to those assets until he pays the loan back. So in the event of the insolvency or whatever, the margin account is not covered by 8511B. The second part is that a margin account will always have a separate written agreement. And I think this came up a bit in an answer to Chair Miller's question. There's always a separate written agreement between the investor and the broker. That separate written agreement supersedes UCC Article 8. The agreement between the parties controls, and in that agreement, the investor has pledged his or her securities as collateral for their loan. So they've given up a claim to those securities until they pay that loan back. So 8511B requires two parties with a claim, and a margin account takes it outside of 8511B because the investor doesn't have a claim anymore. It's unfortunate that we have to drill down to this level, but unfortunately that's the case. I can get into more detail on why this does not apply to margin accounts. And the question that you might ask is, well, then what does it apply to? Be happy to get into that. I'd also be happy to get into Representative Hoska's question about what happened in 1998. Connecticut is an interesting story for a couple of reasons. Be happy to get into that. And the whole discussion on control got sidelined into this margin account rabbit hole that doesn't apply. The control we're talking about, the loan we're talking about causing the problems is a loan between the custodian and the custodian's bank. It has nothing to do with the investor. And that is the level we're trying to figure out why they gave this carve-out protection to the largest banks, the too big to fail banks. Got a lot of things I could talk about on these, but again, in the interest of time, I'll just answer any questions that people have. But the main takeaway here, this does not apply to margin accounts. That whole discussion is a rabbit trail, and it's misleading, to say the least. There is a reason for it, but not that.
Okay, thank you, sir. Any questions? Senator Hoxa?
Thank you, Chairman Doucette. Yes, a few questions as with the other individuals on my bill here. So Don, thank you so much for taking the time to testify today. Let's get right into it. So if you would like to just clarify then how you interpret that whole control argument and who it really applies to according to the UCC codes and any relevant statute. Through you,
Sure. Mr. Chairman, our co-chairs and Representative Hoxa. Sure. So the control issue is at the level of where the custodian or the broker is borrowing from a big bank, right? And control, as was stated before, can be given either with physical control of the assets or by agreement. And 99.9% of the time, it's by agreement. So the loan agreement that the custodian signs to get the loan from the broker pledges a pool of securities as collateral and grants the lender, the big bank, control by that agreement. So when this 1994 change was put into place in all these states, the bank people are not they're pretty bright. So they can read in there that they've got a nice advantage if they have control. So what did they do? They make sure they have control. So control lending really took off in the mid 90s through the 2000s because the banks realized that as long as they have control, if everything fails, they're good. They got the asset. So they're just the idea that there's lending made without a control agreement between the custodian and the bank is, it just doesn't happen. Banks aren't going to do that.
And through you, Mr. Chair. So if I understand this correctly, what you're saying is that the custodian may use the pool of assets that does not belong to the custodian, but is under, as the name implies, that those assets are under custodianship, meaning they're the storage facility. They may use the contents inside the storage facility for a loan for themselves to use to buy positions in the market for themselves, just as an example. Would that be correct? Through you, Mr. Chair.
Co-Chair Doucette, Co-Chair Miller, Representative Hoekse, you have to be careful how you say that. They're not allowed to do it. They don't have permission to use the client assets. This is a situation where they choose to do so anyway. And this is a situation where some entity on Wall Street decides to use somebody else's assets because there's a really good investment that they want to make. Now, that's not me saying it. That's what the drafting committee said for this revision back in 1994. I can provide the official comments to the committee if you're interested in there. But 8511B was put in there in case some wrongdoing was done on Wall Street. So in that situation that you just brought up, Representative Hoekse, if a custodian wrongfully pledges the client assets as security for the loan of the custodian, that's why 8511B was put in there, because in that situation, if the custodian fails, the custodian's client has a claim to that asset because they never gave permission, and the bank has a claim to the same asset because the custodian gave them control. That is exactly the reason that this is in there. So, like I say, it's not me saying it. It's the drafting committee saying that although it's unlikely that anybody on Wall Street actually ever breaks the law, in the slight chance that it might happen, we need to make sure that the banks are protected. That is the reason for 8511B.
I see. So, and through you, Mr. Chair, I see. So no one's naive enough to, allow, to put down that sort of scenario on paper and explicitly say that, hey, this can really be done because there's this little protection in there in case that it's wrongfully done. But essentially what you're saying is that in the event that this scenario does play out, that there are protections for the big players here and not for the little guy. And so if I have that down correctly, if I now have that down correctly, can you elaborate a little bit more on a scenario, on how that scenario would play out? And as I've asked of the other testifiers, and just to give this committee and everybody listening a real world view of how this could be detrimental even at the smallest level. Thank you. Through you, Mr. Chair.
Thank you, Chairman Doucette, Chairman Miller, Representative Hoekse. Yes, first of all, it is in paper. It is written down. I wasn't able to find out if Connecticut has an annotated version of your code. Many states have annotations, have an annotated version that's available. And, this law is the same in all 50 states. So the other states we're working in, I'm able to download the annotation, and it explains exactly what I just said as the rationale for 8511B. Wrongdoing and on the part of the borrower, and it wants to make sure that the bank is protected. So it is written down, and people said the quiet part out loud. The committee did, and it's in the annotations, at least in the other states that I've looked at. So the scenario here would be, you, Representative Hoekse, have an IRA with Charles Schwab or someone. Schwab is the broker, but the broker doesn't hold those assets. The broker the larger institutions wear all these hats, but essentially I'm just going to talk real simple. So let's say that Charles Schwab is the broker. They then trade through a custodian, right? The custodian's a higher level financial intermediary. But that's not even where the assets are actually held. They're held up at Depository Trust Corp up at the top. But in this scenario that I'm trying to give you just in a real world example, so you've got your investments. It shows up on Charles Schwab's account that you own 100 shares of Apple. That's the only place it shows up. When it gets up to the custodian level, it just shows all of Schwab's Apple, all of it, the shares of Apple that it holds on behalf of its customers. So if a custodian is in need of capital, it needs some cash, and they need to go to a bank, they're going to go to one of the bigger banks, the too big to fail banks, and they're going to enter into a loan agreement where they're going to pledge a pool of assets. Now, at the custodial level, the pool, your name isn't on there. Nobody's name is on there. It's just a vast pool. And there's no indication if there's margin securities in there or anything. It's just a vast pool. So if the custodian kind of skirts the law a little bit and grants collateral, pledges collateral of all their shares of Apple Computer that would include their clients to the lender, and grants them control through that separate control agreement that the prior witness talked about, then if the custodian fails, the lender to the custodian has the control, and they've got the priority to sweep all those assets to repay the loan. Under the terms of UCC 8, the lender isn't required to determine whether the custodian had the right to pledge those securities or not. They're absolved from having to look. They don't have to kick the tires or look under the hood. They're given priority blanket. And so in that situation, you're sitting down there and you're pulling up your account at Charles Schwab, and all of a sudden there's zero in it because the Schwab's assets with the custodian got swept up by the custodian's lender. And, you can go to Schwab and say, where's my shares? Where's my security entitlement? And they're going to shrug their shoulders. They did everything right. They followed the other provisions, the safeguards that have been talked about. They followed all of those, but a intermediary at a higher level broke the law, and nobody's there to fix it. It's gone. And again, that's not me saying it. That's what the drafting committee itself said when they put this model law together. Happy to provide that information so you can see it for yourself in black and white, but it's pretty shocking.
Wow, that is just.
I should add, if I could, Representative Hoekse, you as the investor are not totally out. You have an unsecured contract claim against Charles Schwab. You may or may not collect on that, but you certainly don't have any access or claim to your securities anymore.
Wow, that thank you, Mr. Grande. That is truly remarkable to know that that is the case, and I think I finally understand now. And it was really tricky, and I'm glad you explained it that way, because that's the sleight of hand. There is that the Charles Schwab can own Apple stock as Charles Schwab and can also have stocks under custodianship that are Apple, and the pledge to the lender becomes all Apple stocks, indiscriminate. It sounds like what you're saying. And in that case, yes, my personal assets through Charles Schwab as an individual that owns some Apple stock through Charles Schwab, are now at risk because it's been swept away in the same deal with that was where those stocks were, where those assets were pledged for a loan. That's just truly remarkable. And if I just may say so through you, Mr. Chair, it sounds like that's the case, and that's just, it's unbelievable that we live in that world. But so last question that I'll have for you, Mr. Grande, is that what happened in the 30 years, 1998 is, that's almost 30 years ago, 25 years ago. What happened in the 90s that, caused this change to be put into the UCC code and then adopted by every single state? what was not working for an interest, some party out there that they felt compelled that they needed to go to the UCC commission and get this changed. Can you tell us a little bit about the history of what went on here to where we are today? Thank you, through you, Mr. Chair.
Yes, and I'll try to be brief in the interest of the committee. Chair Doucette, Chair Miller, Representative Hoeksa. I may look young, but I actually was around back in the 80s and 90s. And what happened here is that this change, it's called the 1994 UCC Article 8 revision or Article 8 amendment. Actually, the ULC started working on this in 1992. But the genesis of the change is actually the 1987 October stock market crash, when that was a bad one. And I was working in St. Paul in the trust business at that time. And that was a scary day. And it scared a lot of people. And in the aftermath of that, there was a firm called Drexel Burnham Lambert, big in junk bonds. They failed. They were kind of like the Lehman Brothers of that prior prior financial crisis. And that got a lot of people really concerned. And the American Bar Association stepped up and said, we need to do something about this. The markets are fragile, and we need to do something about it. And they initially started to go through Congress to get some changes made at the SEC. But the Uniform Law Commission thought they could handle it better through a change to the Uniform or Commercial Code. So a little bit of wrangling there in the early 90s. The Uniform Law Commission and American Law Institute, they worked together on these uniform laws, formed this drafting committee in 1992 to come up with a change, a revision to this UCC Article 8 that basically did two things. One is it looked at what are the practices we're already doing. Some of them might be illegal. How can we make them legal? That was one thing they did. But the lead drafter of the 1994 amendment, called the reporter, he's the attorney that's the lead drafter, does all the drafting and within the committee. The lead drafter described the 1994 amendment as Armageddon planning for the financial services sector. Armageddon planning. So that's the intent behind this thing. And so what changed? The largest banks saw that they could be potentially exposed to the next financial crisis, and they wanted to put some protections in there to make sure that in the event of a cascading financial crisis, the largest banks are protected. A precursor to too big to fail is essentially what it was. And the Armageddon planning, I mean, the drafting of this bill is really, I do tip my cap to the drafters. You have to do the golf clap and say, you guys did a pretty good job, because it's since 1998 in Connecticut, it's worked effectively pretty well. And it was designed to. It was designed to give the appearance of normalcy, that, you can buy stock, you can sell stock, you get the dividends, you can vote. That's all fine. But lurking in there is an insurance policy that's going to kick in if and when needed, that's going to protect the big banks. And that's the Armageddon planning.
Thank you, Mr. Grande. I appreciate all your testimony and answering all my questions. And I think at least now I, at the very least, have a very clear understanding of what was going on here. Thank you for that testimony, and thank you, Mr. Chair, for allowing those questions.
Thank you, Representative. I do have one at the risk. We've been here a while, and Grande, you got to go. You're last on our list, so I don't know if that's good or bad, but thank you for your patience and your testimony. But we heard a sleight of hand. We heard Armageddon, which, and we heard an earlier speaker say conspiracy theory. And I guess I have the same sort of question and concern in light of what we're talking about here. But I have just one question for you. Do we not already have existing securities law, both on the federal and state level, that prohibits a securities firm from loaning out a customer's assets without their consent in any way for the benefit of the institution. And wouldn't then those institutions be subject to civil or criminal liability if they were to be violated? And I'm talking about the Federal Securities Act. I'm talking about the SIPC Act, FINRA regulations, Connecticut state law and regulations. So again, you said sleight of hand, or I forget what the term was used, if there was some impropriety, I mean, certainly, and then investor protections kick in. But so my question is, don't we have existing security laws that basically say that what you are describing as happening is already illegal on many fronts, state and federal laws?
Mr. Chair, and I do thank you for the time you've given to this topic. There are federal regulations, laws, Securities Act of 1934, the Investor Protection Act, the SEC, FINRA, SIPA, SIPC. They're all there. And ostensibly, they're there to protect the investors. Opinions differ as to how good a job they do. And again, I've used the term Armageddon planning. That wasn't my term. That was the person that drafted this model bill. He used that term. And the people that drafted this bill, the drafting committee, also acknowledged that there are other laws out there, federal level laws that are there to protect the investor. They may or may not. I can get into specifics as to why SIPC doesn't offer the protection that is touted, but I think that's beyond what you want to get into right now. But all of these regulations out there that prohibit this activity, that still doesn't mean it doesn't happen, right? So if it happens, then there could be, fines from the SEC and things like that. But the bottom line is that if it happens, if a custodian wrongfully pledges securities that it didn't have the authority to do, and those securities are lost in a insolvency, the investor still loses it, and it comes back to the state to figure out who has priority. So your state statute, the lawmakers that passed this in 1997 and then amended it in 1998 in Connecticut, are putting a lot of hope and prayer into those federal protections. The drafting committee did too, but then the drafting committee at the end of the day said there's still enough risk here that even with these federal protections that the banks could be in trouble if this happens. So they put 8511B in there to protect the banks. Now, it may be that protection to the banks at the expense of the individual investors and institutional investors is the right thing, but I don't think we had that debate. I don't think your constituents aren't aware that their stocks are potentially going to be used in the event of an insolvency. They think they own the stock. And so if you're going to have a state law that is going to allow for the sweeping of individual constituents and state assets in the event 8511B is triggered, they should at least be aware of it, and there should be an open discussion, should be part of a vote, and it just hasn't been discussed.
Okay, well, thank you again. It's an interesting discussion. Appreciate you joining us today from North Dakota. We've had North Dakota, Texas, and Sweden. That's appreciate it.
Thank you, Mr. Chair.
Okay, and we had one additional speaker who was registered, who I've been informed had to leave, but submitted written testimony. So with that, we're at the end of our speaker list, and we'll close the public hearing. Thanks, everyone, for joining us today.
Thank you, Mr. Speaker. Thank you, everyone.
Thank you.
Thank you.